It has been 2 days of very, very interesting interaction that has taken place on this workshop, mainstreaming climate finance actions in national DFIs. So once again, participants who are present, who are on now, I'd like to thank you for being part of this. I'd like to thank you for and I'd like to call upon all participants to mute their mics. Please mute your mics.
It is done, Mr. Moses. Thank you.
Yeah, and your videos should also be off for now, apart from those who will be presenting. So in order not to waste our time, we need to move very fast so that we can meet a record time for closing this workshop today. We'll be taking a program recap of what happened yesterday, briefly, just for about 5 minutes to 10 minutes. So to do that, I'll be inviting Dr. Linus to do the recap.
Good morning, and thank you very much, Moses, for introducing me. Thank you very much, everyone, for attending today's program. Yesterday, we had 4 different modules. We took 2 modules in the first section, where Belinda and Sarah anchored presentations. And the morning session, we had the topic on climate risk and opportunity screening on project and business operations. This module highlighted what we need to know as we deal with private sector companies, how they can mainstream climate change operations in their business activities. After this section, we also had a session to more like have hand-on toolkit demonstration. It was coordinated by Sarah and Belinda. We were shown how the toolkit worked. This was followed by the second module of the day, which dealt with business carbon footprint. This toolkit was more on how to relate with SMEs and bigger firms, private firms, how to quantify emission based on adopting best practices in their business operations. So after the lecture, we also split into 2 rooms for a breakout session to understand how these toolkits work. So these were followed by a short time for questions and answers. And I'm sure we had some good time because questions were posted on the platform that responses to these questions. Then this followed by a second session on climate finance. The first of it was module 8, climate and environment finance at Aiafd Trust Fund. It was taken by Mr. Garrett Phillips, the manager climate and environmental finance division. We also had second module that has African Finance Alliance for Climate Change, AfDB. This was taken by Davida Million Luwela, the principal of AfDB. In all, after we were done for presentations, sessions, we had a rich question and answer session today. The facilitators to attend. So without taking much of our time, very sure that yesterday was full of activities and all very responsive and active to see the comments. And we thank you very much for participation. So I want to hand over to Mrs. Moses. Thank you very much. Thank you.
Yeah, thank you very much, Dr. Linus. for Dr. Linus Orakwe for that brief recap. We'll be going to our first presentation today, which is Module 10. Module 10, and Module 10 is talking about project development and financing instrument for bankable projects, the role of DFIs, the role of DFIs. And that will be done by Stalinos Day. Stalinos Day is a financial expert, financial risk expert, and he will be leading us on this. Stalinos, please, you have the floor. Thank you very much.
Good morning, and thank you very much. Please, if I can be enabled to share my screen. Can I go ahead and do that?
Please do that. Go ahead.
Yes, sir.
Can you see my screen now?
Yes, just missing to put the presentation on full screen. That's all. Thank you. Yeah, perfect now.
Presentation mode now.
Go ahead.
Okay.
Yeah,
thank you very much. And like we all have done, I'll try to go through this quickly. I have about 40 minutes to do this. So, like we rightly said, the project, this very session is on project development and financing instrument for bankable project, the role of developing finance institutions. Basically, I will go through quickly what the typical financing instruments are that most of us have been in tune with already, what the requirements are to access these funding instruments, what the challenges are that are faced by developers, and what the DFIs are and what their critical roles are in these projects. I just put this summary to just give us an idea how key and important it is for DFIs to support the whole nationally determined contribution projects. But more importantly, in this presentation, I want us to focus on a little more practical things. This is a point where the real users of money or funds or the developers try to get access to implement climate finance or sustainable finance. I would prefer a lot more about sustainable finance, but it's not only climate finance, but sustainable finance. I also thought that I should give a typical example of a project that we can all easily relate to in Ghana that will tell us what presently project financiers are going through that calls for more collaboration under our Goal 17, Sustainable Development Goal 17, that's a partnership that will tell everybody that doing this partnership will be the best way for us to be able to meet whatever goals we set for ourselves. So I just want to give a typical example of a case study of a business that I know very well that struggles now to finance itself because they have gone into sustainable finance or climate finance, and their way of doing things are quite different. So I'm saying that BBG, and I'm taking the example of Building Back Green. It's a well-established wage management company. That is just a name that I designed myself. That had been in business for 15 years. BBG banks with one of the regional banks. They have struggled to buy equipment such as compactors for waste collection because the banks only finance equipment which will not be more than 7 years old at the time that the facility matures. An average compactor is about 226,000 euro. Now, BBG also buys fairly used ones from Germany of man diesel. Again, these waste management companies needs very strong vehicles to be able to do their work. So sometimes they buy the home second-hand ones. That will be about 50,000. But again, the typical commercial bank cannot finance because it will be more than the 7 years old. But these trucks, again, can live longer than some of the ones that we get from our other colleagues and in other parts of the world, which might just stay for 3 years and 4 years and get spoiled. So what is the major challenge of the company? The major challenge is that The typical financial institutions will ask for collateral. There is a shorter tenor in this case because the tenor for which the equipment is being given out is too short for the client. There is high interest rates. Pandemic disrupting their client businesses, a new problem on board, and lack of knowledge of their bankers about green and climate projects and sustainable projects is a problem. Now, the governments and institutions are also supporting cheaper provision of fertilizer. Meanwhile, these people, because they are no longer just a waste collection and dumping company where they just collect waste and go and dump it in the landfill sites, they are recycling their waste. So they are doing waste management and not waste collection. They are recycling their waste. They are turning waste into compost because significant part of our waste in Ghana, about close to 60% is organic waste, which you can turn into compost to be used as fertilizer. But again, governments and institutions are subsidizing fertilizer against some of these people. And what it means is that if you're not producing more than 1,000 tons, you don't benefit from that. So that's just a case study and a typical case on the ground that we should be thinking about whilst I go through the various instruments that are available for them and why it is then critical for development finance institutions or developing banks in the countries to collaborate for all of us to be able to finance sustainable finance. Now, typically for sources of finance, these are the typical sources of finance when it comes to equity. So it could be that that project developer gets his personal money to do the business, get money from friends and family or crowdfunding, angel investors who help, investor capital, and IPO, or they'll do a public, initial public offering, which is very rare, looking at the size of our type of clients. So basically, this is just a little elaboration on this. These are not things that are new. So I'll move quickly to the next one. Now, again, when it comes to this equity financing, there are expectations from people who finance these projects. So this is just a typical situation of expected internal rate of returns that some of these financiers are expecting. So it's not easy for these developers when they are going in for this financing. It is not surprising that most of them will always want to tell you, we want grants because maybe that one comes cheaper to do a number of the things that typical commercial banks or those of us who work in typical commercial banks don't understand, like feasibility studies, technical assistance, capacity building, and all those type of English are things that a typical commercial bank just want to give you a straightforward loan, pay me this, or I'm investing in your business as an investor, pay me this percentage. We are looking at your sovereign risk. You are high risk, so pay me so much. So this becomes a critical issue for the a development project person that really makes it quite difficult sometimes to assess the funding that they need. Now, for a typical debt sources, we are talking about friends and family. Commercial banks are mostly the significant part of public or private sector funding. There are very, very, very few people who actually have access to the funds that we talk about. I listened to my good friend Philip yesterday, and most of the things that have been said, it looks very fantastic, but the truth is that very few people in the private sector have access to these sources of financing, and the public sector who have access largely work in silos. So this collaboration that is coming up now will be very significant in pushing our agenda forward. So moving on, there are other financial institutions that also finance these projects. So I just thought I should mention some few of them. Definitely Green Climate Fund is there, but those are a very significant one. But the smaller ones like Wangara Green Ventures, SMV, Norfund, and all these ones are also institutions that are funding the sustainability space. But now let's move on and see what other funding will have been critical for some of these financial institutions to survive. So typically for a project developer that is struggling to maybe do feasibility studies, build capacity, understand technical things themselves, definitely they will be looking for a grant.
Name.
Hello? So people looking for typically situations like that would be looking out for grants. And typically these grants will help in terms of business not generating cash flows, like I already said, technical assistance and physical feasibility studies, upfront knowledge generation, and then also in issues like filling in the gap when equity, to support some of the projects. So for instance, for a typical project like the waste management project that I've spoken about, there are in recent times some organizations that had to help these waste companies during the pandemic, give them grants to continue to even pay salaries because they were not getting money from their clients. Their cash flows were impacted, and that helps to sustain the businesses. Concessionary loans becomes very critical because for the type of investments that we are looking at, which has got to do with climate change and public good, concessionary loans become very important for us to be able to meet the needs of some of these developers, or maybe almost all of them. And knowing that most of the time, the institutions in the public sector wants to do things like command and control. You want to manage the waste issues, pollution issues, base some of them on market-based incentives and all that, feed-in tariff and all the other things that we do in this space for climate change and sustainability. There is definitely the need for concessionary loans. The fact is that as we talk today, it is so difficult to get concessionary loans in the market. So the need for the DFIs and the development banks, and necessarily collaborating with the commercial banks who significantly manages these segments of financing project managers. So this could come in as direct loans or on lending facilities from commercial banks, for instance, to the final project developer. So I'm looking forward to, for instance, a situation where there is a lot more work being done between institutions like African Development Bank and the commercial banks in coming up with products and services that can facilitate some of these concessionary loans in areas that are of public good and commercial banks are not willing to delve into because they don't make immediate profits. And naturally, commercial banks are very short-term in nature. Now, loan guarantees or de-risking is also a critical area that add a lot of value to the previously identified sources of financing, where now either government or the international institutions, bilateral institutions, multilateral institutions, and in the typical case of trying to groom this in Africa, we are looking at development finance institutions or national development banks coming up with things like loan guarantees. I mean, I know institutions like African Guarantee Fund doing some of these things quite well to help projects that either are not the types that commercial banks want to work on. Now, so this is, for instance, a typical example in this structure where we have a situation that a project needs to be financed and a guarantee can be given from an institution like the World Bank, but could get an indemnity, for instance, from the National Ministry of Finance to help such a project to go on. Definitely knowing who the World Bank is, the National Ministry of Finance will definitely don't want to default on such commitment or on the agreements that the World Bank will give to maybe a commercial LC provider to do such a project. So this is a typical situation where concessionary facilities could be used to help project developers. Now, I'll go straight to now the issue about what the development finance institution is. So from the World Bank definition, the financial development finance institution is a bank or financial institution which is at least 30% owned by equity of the state, and has the mandate to reach social economic goals in the region, sector, or a particular market segment. Bearing that in mind, we'll realize that that is largely managed by government or the public sector. That is where I am always pressing for the need for a lot more collaboration. Because if the institution is being managed by the public sector, mostly the private sector just also want to do their own things. So for a development bank or a public one, we are looking at financial tax with promoting socio-economic development in the region. So the expectation of these financial or development finance institutions we are looking at is for them to champion or lead the issue of sustainable development, green economy, climate finance, and all that we are talking about. Then NDCs, the nationally determined contributions, are the significant portion of this. Almost all countries have committed to these goals. In my country, we have about 35 goals that we are looking at, and key among them are things like energy, water, waste. So I'm very, very passionate about waste, because waste is one area that most people don't seem to understand at all. Very few people are supporting waste. So we'll go now to what is the role of this development bank. So we are saying risk-taking in line with the political, social, and economic, environmental, economic targets of the various countries. So basically, the expectation is that these DFIs or NDBs will lead or be willing to take the risk that pertains to financing that will lead us to, for instance, go into climate finance, go into the green economy, go into sustainable economy, finance all the, or attract people to bring the blue bonds, the pandemic bonds, all the various type of bonds that make sure that funding is actually being used for the intended purpose. This is one of the critical roles of this institution that we are so much passionate about and want to happen in Africa. It is not like it's going to be the first time or the new thing in Africa. We have all had some form of development finance institutions, one way or the other. As to whether they have worked well in the past, that is a big question for us to answer. But the feeling now is that we can all collaborate to make it work. Long-term financing, minimum of 10 years plus, because most of the commercial banks can give funding maybe average of 5 years and a maximum of about 7 years. The thinking around this, the role of these DFIs, is for them to be able to give the long-term facilities for institutions, private sector, to go into things like mini grids, the solar home systems, and all those ones that we use in the businesses. But if those products or projects can stay for longer term, 25 years and over, we should be able to now think of giving out facilities beyond 10 years, 15 years, and others. I want to believe that some of the products that Boss Philip spoke about yesterday will meet some of these conditions. Provide public good, yes. There are some of the things that, like I said already, that the typical commercial person might not necessarily want to go into because they don't see immediate benefits. And the banks can also support or also facilitate access to capital indirectly by collaborating with private public partnerships. And this is a typical example where in 2016, development banks were responsible for about 124 billion of climate finance, making 89% of the public sources of climate finance. So that tells us clearly that the role of DFIs or NDBs are critical in this very project that we are embarking on. New market standards. Development Bank has exhibited leadership through the development of new market standards and pioneering green practices within the private sector. For instance, one of the things in my country that I always say is the lack of, for instance, a clear green taxonomy for financial institutions, for banks, for insurance companies, for stock exchange, and everybody to follow, for instance. So when you say green, what is green? Who qualifies for green? So we don't come back and say, oh, okay, you are greenwashing. you are at the different shades of green. So the expectation is that one of the critical roles of these institutions as well will be for them to lead in developing some of these standards. Development Bank has also been instrumental in establishment of the green bonds. I've mentioned that already. And fill the capacity gap. Development banks can provide technical assistance. Again, that is if they have it themselves, because it is also clear for most of the African countries that yes, there is lack of capacity even within the public sector and even some of these financial institutions. So there is also a big collaboration that needs to go into it to make sure that the right people are in some of these institutions. Ghana, for instance, is now coming up with a national development bank specifically to support this sustainability sector. It will be interesting to see who are the type of people working in those banks and what capacity do they have in climate finance and all to support, bridge the capacity gap in other areas. Now, I also want to touch on some of the challenges that are faced working with DFIs. So it is not all rosy. Yes, the DFIs can have the funding. DFIs can be willing to support, but what are the challenges that others have complained about? Some of us have worked with SMEs for the past 25 years. And these are some of the things that typically on the ground we have identified. Unfamiliar requirements. So again, because of climate change, environmental and social governance issues, now all these people need to be able to come up with one way or the other, some policies that talks about environmental issues, governance structure, social issues. And if they are not guided, this is not the normal way they work. So it's very unfamiliar requirements. Grievance mechanisms needs to be put in place for people to qualify for some of these funding from DFIs. So there's a lot more education and training that we need to do for these project developers to be able to cope with working with DFIs, or even if in the future commercial banks stand up to the game to be able to work with them. High interest rates, yes, as much as we perceive DFIs and NDBs to be the reliable source of financing, concessionary loans and all that, most of the time what we see on the ground is DFIs and others coming in to say, oh, okay, we don't want to distort the market. So the interest rates are still high. They are unable to reduce interest rates to the levels where you are able to do more. So that is another thing that we have to look at. Do we always want to complain about, okay, we don't want to distort the market, or these development banks will now come out with rates that are realistic, that will get the work done, than looking at what is going wrong with each of these markets. Loan sizes sometimes are limited, they are capped. You are giving what the institutions want to give and not what you might necessarily need. Lack of technical knowledge by personnel of the financial institutions, yes. So now you have developers who understand their work. The financial institutions that might be working with the DFIs don't understand. So there is a difficulty. Very long facility process period. So this is not new. We know how long it takes to get monies from development finance institutions. And that is another thing that we have to look at as some of the challenges. And it doesn't mean that the DFIs don't also face challenges from the public. What are some of the challenges that the DFIs face from developers and maybe with the intermediaries that are commercial banks and others? Lack of documentation is very, very prevalent. Poor proposals, people not really understanding how to put together proposals. It was so exciting in recent times when we had this training on the GCF proposal development with Belinda. That was a fantastic training that gave even some of us who thought we were in the financial sector already some good insight on how we have to approach putting together proposals for these development institutions. And I think that that is one of the things that we need to also see how, for those that have done some of these programs, help to scale up training people across the sub-regions. Very, very dear to the heart of some of us, and we need to do something about it. Lack of governance structures, inadequate staff in some of these institutions, lack of appropriate skills and experience low equity contribution to projects is a significant thing that most project support people are not happy about. There are a lot of project developers who seems not to be bothered about how much they contribute to the project, but they write all the good English around why the project must happen, and that is not good enough. And most of the time, you also see lack of exit strategy. So this person puts together a very nice proposal, but how their project continues after that grant is given, after that concessionary loan is given, after that guarantee is given, is totally absent. Now, I'll jump quickly to the new areas that we think or we believe there are opportunities that we can collaborate with the national development banks or development finance institutions to progress in our new world of sustainability. So the first one is that the national development banks will lead on building pipelines for development of low climate resilient economy. And I heard again, Boss Philip, when he spoke yesterday about we taking the initiative to approach their offices in our various countries to see how our projects fits into the projects that, for instance, AdB is carrying out or other development institutions are carrying out, national development banks are carrying out, and see how we can collaborate to develop those projects. Capacity building in sustainable projects, yes. Technical assistance, we have mentioned already. Collaboration with other financial institutions to drive blended finance to the benefit of all. So blended finance definitely is the way to go. It is clear from even this pandemic that no one can do it alone. When the pandemic hits, all that commercial banks could do was to say, okay, I can reduce your interest rate small, I will defer your payments and all that. But nobody was able to give a grant. Nobody was able to give maybe a concessionary loan. So it tells clearly, if we don't work together, there are a lot of areas that the people who manage the chunk of the markets lack expertise and lack product and services to support. So yes, blended finance is the way to go, and we have to collaborate. Drive funding from institutional investors. Make sure that we are also using our institutional investors, the pension funds. Where are we investing them in our various countries? How do we make sure some of these funds go into the national development banks to facilitate the development in those areas that we think we need focus: climate finance, sustainable finance, green economy, all the bonds that we want to put together to develop our economies, energy. How are we making sure that some of these funds are convinced or spoken to understand that that's the way to go across the world? Mobilization of local funds for local projects is key to prevent high-scale indebtedness. Again, there is quite some money locally as well that we can depend on. It is also not true that all the funding needs to come from outside. If we mobilize our own local funds very well, we could put it in more profiting and beneficial projects. Local DFIs should ensure presence of national schemes present at international scene and drive access to international fund as well. Green Climate Fund is a fund for everybody. But what you can see is, like in a typical African setting, it is how fast you can eat from the bowl. So if you don't have the capacity to do that good proposal, defend why you have to get this funding, it is almost impossible for most of us to get this funding. And it is clearly demonstrated in what is happening in Africa now, where we are almost, I'm sure we are the least that is benefiting from these funds because we are unable to put together those compelling proposals to attract this funding. So the national development banks definitely will come in handy to also support with these opportunities. Establishment of green funds and banks has also supported sustainability. So it's another area that we have to look at. Thank you for now, but my case study is still there. We still have some few, I think I still have some good time here. If we have any participants that want to talk to the case study that I've spoken about and also contribute, that would be very helpful. We have still, I believe I have 40 minutes. I still have about 40 minutes for us to give inputs. But for now, thank you very much.
Yeah, thank you very much, Stalinos Day, for that wonderful presentation. So we still have about say 8 minutes or 10 minutes more for him. So is there anyone who wants to make any kind of contribution? If not, we will move to module 11. Is there anyone with any kind of contribution? While we are waiting for that, please let Dr. Jubri Adeojo get prepared, because he's coming up next with module 11. Okay, a hand is raised. You can speak. Boyega, you can speak. Unmute yourself and speak.
Okay, good morning, everyone, and thank you for the opportunity to speak to the audience. So my contribution in form of question would be, we still have a number of SMEs who are closer to the grassroots, who are closer to the, to the bottom of the pyramid, and they are struggling to gain access to funding to also provide services to the community. How can, we were raising the issue yesterday, and then somebody came up that the collateral aspect of this processing are still very, very high. How do we assist this type of SMEs, MSMEs to be able to meet up? Are we also looking at collaboration for them to be able to scale through this? Do they need guarantees? If they need guarantees, who would be the most possible set of people or organization or financial institution to give this to them?
Yeah, thank you very much. Yeah, thank you, Boyega. So, Stalinos, can you take that on?
Is it rather a question to me?
Yeah.
I thought we are all complaining, so.
Okay. Okay.
So,
I'll put it this way.
So for me,
okay,
there is still a big opportunity. So for in my country, for instance, I am a commercial banker. I have taken the initiative to make sure that I work closely with Ministry of Environment, Science, Technology and Innovation, the Environmental Protection Agency, and basically UNDP on the government institutions. Because again, when we sit in the banks, we only think about what is happening in the banks. But if we work with these people, then we can work together. For instance, I am also looking at developing some products and services in the banks now, knowing the conditions of the SMEs, to be able to give the sort of funding that fits them. So I think the answer to the question will be collaboration. I mean, and it is part of the SDGs. Goal 17 say partnership. So I believe that if we partner, we should be able to deal with these issues without having big challenges. The fact is that we are still working in silos. Everybody is doing his own thing. And I can tell you there are skills that we need from each of the sectors to be able to deliver this. So that is what I will have to say. Okay, then.
Thank you very much. Before I call on a second person, then we can move to the next module. There are some comments here. One from Erodot Gray. He talks about lack of collateral. And Sorajo Ibrahim Shehu is also talking that collateral is a major challenge. So what do you have to say about this, Stalinos?
Okay, so yes, collateral is really a big challenge. And it's also basically because of risk. So I think collateral issues will definitely be solved by de-risking. The de-risking policy instrument from government, the de-risking policy instrument from the National Development Bank, the de-risking policy instrument from other international institutions will help. The banks only ask for collateral when they think that the transaction is risky. And quite apart from that, they ask for collateral against because they don't understand the technologies. I know a situation where solar systems, collateral is being asked for you to do mini grid or solar home systems, which is unnecessary because the equipment itself has value in itself. So I believe that the moment a lot more education is done, especially for the commercial banks, we should be able to do this without asking for collateral.
Okay, thank you very much. So, Tondera Jowera, unmute yourself. Please go directly to your question and ask. Thank you very much.
Thank you very, very much. My name is Tondera Jowera, and I am a sustainable finance expert. So mine is actually a contribution just to add on the beautiful presentation that has been made by Stanislas, who is actually my classmate apparently. proud to be sharing this platform with you. So it's just around the various instruments that can be used, particularly for our climate initiatives in different facets, and through either small to medium enterprises, or even through our development finance institutions. The ones that have already been mentioned around bonds, the green bonds, the sustainable development bonds, and even microfinance and sustainable banking or lending. The ones that I actually want to talk about are more of the social impact bonds, which can be used in collaboration, like what Stan said, between multilateral institutions, between even the development banks, with the small scale enterprises, whereby we're looking at paying for success, for example, where we have water as water or waste collection as a case example, and the impact that is then derived from such projects can be paid for by another player who is probably a philanthropic player, who is in partnership with the government, with the project developer, and whoever is the client. So those are the basic ones that I just wanted to talk about, among plenty more. But yeah, just I thought, let me just give a small contribution. Thank you.
Yeah, thank you very much, General. So we are moving to module 11. Before then, we are seeing the comments people are making on the chat. We encourage others to do same, and they will also encourage Stalin's Day to also try to respond to some of those comments directly, so that the interaction continues. So, our climate finance expert, Dr. Jubri Adeojo, will be talking about case studies of successful climate finance projects on the continent and DFIs experience. That's Development Finance Institutions experience. That's module 11. So, Dr. Jubri Adeojo, please, can you share your slide?
Moses, 1 minute. Let me just do that right away. 1 minute. Can you hear me, Moses?
Yes, I can hear you. I can hear you. So just share your slide.
Okay. Okay. Can you see my screen, Moses?
Yes, but change to presentation mode. Change to presentation mode.
Okay, 1 second.
Up, 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 up.
Okay. Okay. Good morning, everyone. This is good morning from Lagos, Nigeria.
Good morning, Mr. Jubri. Can you put your presentation on full screen mode, please?
I have done that.
No, not quite.
No.
Not quite, not quite. Go up to your top left. Go up to your top left. You will see those thumbnails have to go off. Those thumbnails have to go off here. So click on the first slide. Click on the first slide.
Okay.
Wow.
So okay, one sec. Let me switch to PowerPoint because I'm using the PDF.
Yes, yes, please. Thank you.
Yeah,
Thank you.
yeah, switch to PowerPoint. So while we are with Dr. Jubri Adeojo, please ensure your comments keep coming. And Stalinos, like I mentioned earlier, please continue with the responses on the chat box. Thank you.
This is perfect, sir. Go ahead. Thank you very much.
Okay. Fantastic. Fantastic. Okay. Okay. So, good morning, everyone. My name is Jubril Adeojo. What we'll be doing today is just to walk ourselves through how we can explore practical cases of climate financing in Africa. So what I've tried to do in this presentation is to not just talk about what has been done, but to paint scenarios and cases of what happens and what leads to creation of some case studies. Just like Stan just did very well. I would also like to just very quickly build on blended financing, because Stan just made a very key point, which is the fact that
Dr. Jubril,
we can't do it all alone, right? We need to continuously collaborate with other.
Dr. Jubril, can you hear me? You are breaking, Dr. Jubril. Dr. Jubril, can you switch off your second, whether your phone or one of them, if you have two items on, please switch one off.
So I'm using, but that's not a problem, you know, because the one is muted. So I'm using my phone to speak because the internet there is stronger than my laptop. So can you hear me now?
It's still very poor, very poor.
Hello, can you hear me now?
Okay, better.
It's better now?
It's so it seems. Continue.
Okay, so in just about 10, 15 minutes, 5 to 10 minutes, I would like to run us through how as much as possible should be when they have to do with climate finance. I won't bore you with all the instruments. My various speakers explain these various instruments, right?
Dr. Jubril.
But the key thing about
Dr. Jubril.
financing is that
Dr. Jubril, it's not working at all. It's not working at all. So I would suggest that we quickly take a 5 minutes break while you try to see if you can change your connectivity. So while that is on, we are free to continue to send in our expectations and then general comments on what has happened in the last 2 days. It's important that we begin to hear from you. And your suggestions can begin to come in. You don't have to wait till the end of the workshop. Let us begin to see and know how you feel and your suggestions.
Yeah, Moses, I'm back now. Can you hear me?
Yes, I can hear you. Please go ahead.
Okay, okay. So I've switched to a better network. Apologies for that.
Okay.
Let me just share my screen. Apologies. Very good. Can you see my screen?
Yes, Yes, we can.
Yeah, it's clear. It's clear.
Oh, beautiful. So I was just trying to explain to you why it's so important that when it comes to green financing, one thing that is for me very important that must be part and parcel of how we fund climate project is blended finance. Because what it does is that blended finance is able to mobilize not just private capital, but also public capital, right? So that we can leverage on the various supports and assistance, and resources from all those parties. Because we're able to leverage, we're able to also strengthen the returns, and we're also to deepen impact that we're all trying to achieve. That is the complementarity that blended finance brings into any financing of any project. So it's very important that it's part and parcel of our work. And from research, right, what we've also found out is that when we engage in blended finance, what it also does is that it also pushes or enables the financiers, the lead financiers, to achieve the impact goals of that transaction. Because if a commercial bank, for example, is to lend to any transaction that is climate finance, okay, the focus of the bank is essentially more on the commercial viability and if that project will pay back itself, which is extremely important. But equally important is also that we don't lose sight of how we track and maintain and deepen and sustain and deepen the impact of the SDGs or any impact you're trying to achieve on that project. That is the kind of thing that blended finance also brings into this into financing project, not just about deployment of capital, but also deployment of technical resources and assistance. So I have a couple of scenarios here as we think through how the AfDB will be conducting various LOCs going forward. So what I have in the first one was how can we leverage and blend the AfDB LOC going forward, being climate focused, with donor fund, either grants. The reason why that is important is that there are some projects, particularly when it comes to off-grid, mini-grid projects on the continent, that are not very bankable if you have to look at the project on the surface of just the project, without having to bring in either a grant injection or a technical assistance facility from a financial donor. That needs to be very, very strong, because what we have that is very, very common is that there's always lack of communication and collaboration between development DFIs or even commercial banks and a lot of all these impact investors and NGOs that are even operating within the countries where all of us are operating from. So that collaboration needs to be strong, so that as the NGOs, impact investors, financial donors are investing in all these mini grid, for example, because of the Powering Africa, energy access, but by the time the bank come into that, they're able to blend their commercial loans or concessional loans that they get from the LOC, from AfDB, to scale the impact and the rollout of such projects across other communities in those countries. So that is the kind of thing that are possible on how should we leverage LOC from AfDB. Another potential opportunity here is how can we also use guarantors? Stanley mentioned that so well, okay? We have a couple of institutional guarantors locally, right? So on the continent, like AGF, we also have a lot of DFIs on the continent that are also doing impact and guarantees. For example, DBN, for example, in Nigeria, we have some in Kenya, we have some in Rwanda. So that kind of guarantee is very important, because I saw again in the comment that collateral is very important. The thing about collateral is this, is for us to even start defining what collateral is. Because like what is very common is that when we say collateral, a lot of us just think it has to be landed property. What financiers are just asking for is that if anything goes wrong, what is our fallback? So guarantor is a very key way to really crowd them in as part of blended finance. Blended finance is not only about the money coming out. A guarantee is also part of blended finance because it's an indirect financing. So partial risk guarantees can be done. I do not always support that a guarantor should guarantee 100% of any bank's funding because commercial banks are also there to take the risk, and they must also partake in ensuring that such investment is sustainable. So partial guarantees are there, that we can always blend with AfDB's LOC. The other key thing again is this. AfDB can give some LOC to a DFI or even a commercial bank. I will also recommend that what we should also do is that if AfDB gives us, for example, a $10 million LOC, concessional financing, how can we blend that LOC with our own commercial bank to reduce the interest rates given to investors, to the developers, SMEs, and also to be able to enable us to capture more SMEs? Because a $10 million, for example, LOC from AfDB can probably impact on, for example, 100 SMEs. But imagine you're able to blend that money with a $20, $30 million of the commercial bank or DFI. You have 40 million. They can actually impact on times 4, times 5 of those SMEs across different sectors. Again, leveraging again on guarantees. Yes, the conditional terms from AfDB, no collateral, long-term funding is good. But because the commercial bank are also staking their own money, commercial debt, to test the waters in this green area, there's need for a de-risking. Leveraging partial risk guarantees is also very important. Again, this communication and collaboration is currently is still lacking in many countries in Africa. It needs to be stronger, right? So again, private equity, again, also very, very poor, for my own experience at the continent. Very few PE fund, VC fund have strong collaboration with commercial banks or PFIs. That needs to be very, very strong. And again, if you know AfDB very well, AfDB has also floated a lot of funds in various PE and VC funds. So what AfDB is doing alongside giving LOC to PFAs and DFIs is also to introduce these DFIs and PFIs to the various equity fund that AfDB is also a shareholder in or also an investor in. Because for example, even the AGF, African Guarantee Fund, AfDB is one of the pioneer shareholders in that same guarantee company. So that is also very, very important. So not just about getting money from AfDB, but also asking AfDB, do you have PFAs, VCs that are focused on the target sectors that the PFAs has identified that they want to play in when it comes to green financing? So that's the way I see that we should think about all these things, right? So this one, for example, is going back to what Stanley said about bond. This is the bond structure. This structure is actually what is being done, for example, in a company that I co-founded, 1 Watt Solar. This is a structure we're launching. We're actually issuing the bond next week. That bond is a green sukuk. It will be the very first green sukuk in Africa. So we have African Guarantee Fund providing partial guarantee. We have about 20 solar companies that we've been able to aggregate as co-obligors into the SPV. And on the back of that, we're issuing a 7-year green sukuk for 7 years. What are we doing? We're providing clean energy as a service to commercials and industries in Nigeria, having the plan to scale to the rest of Africa next year. So my point anyway is that these are the kind of structure that we're looking at. Why are investors investing in the bond? Because it's a guarantee backed by AGF partially. We have a rating, an investment grade rating from a local rating agency in Nigeria. We have FSD Africa, funded by DFIs in the UK, providing technical support for this transaction. Again, part of Blended Finance, they were the one that appointed the Green Bond Verifier. They appointed the rating agency. So we're able to crowd in all these strategic DFIs to have their own support and value into this entire transaction. We have a commercial bank being the anchor investor in the transaction, actually Sterling Bank. So that is how it works, because from the get-go, when we were developing the entire structure, we brought everybody together on the same table and we make it work. So it's very, very important. Collaboration, communication, engagement from the point of project origination is critical, So, and this is also another one, you get these copies. These are how I believe we have to be thinking, because I will make this final point as we go to the case study. we all know that we need $3 trillion for Africa to be able to meet our NDCs across the 56 states, countries, right? Now, this $3 trillion is not sitting with commercial banks or DFIs locally in our various countries. We have money with pension funds, we have PE funds, we have grants, we have all sorts of funds everywhere that makes up the $3 trillion that we need. Now, there are different gestation period or stage of every business or project that can be able to tap or attract all through various monies from the various stakeholders in the financial system. Now, that is how we have to think. So if a commercial bank is able, for example here, if a commercial bank is able to fund directly a project or 5 projects from the get-go, from your commercial loan or from a loan from the LOs, from AfDB, after a year or 2 years, when the cash flow is steady and consistent, why can't that commercial bank or DFI securitize that entire portfolio, issue a bond or a green bond on top of the existing cash flow that is consistent, and use the green bond proceeds to refinance that old commercial loan and then fund new projects? Because pension funds are looking for projects that are already generating good cash flow. So why should a commercial bank keep that if all of us are collectively working to achieve that NDC target by 2030? That is how we should be thinking, because that is how that's the only way I believe we'll be able to really achieve the NDCs by 2030. The thinking needs to change. It's about collaboration, partnership. And the NDC 17 is always about partnership. So that is what I would just like to say here. Before we go into the case study, I would like to show you a snapshot of how we can mainstream climate action. What kind of activities are we able to finance within the value chain of agriculture, right? So we have from production all the way to wholesale and retail markets. Now we have all the players. These are the potential people that we can, SMEs that we can fund or companies that we can fund, either to decarbonize, to mitigate, or to adapt, to build resilience for climate effects. So all these boxes, the ones in green are the ones that has to do with efficiency, renewable energy for mitigation. The ones in orange are the ones that talks about adaptation. So the question is, into the case study, how can we finance all these different components? Thinking about the blended finance, thinking about the structuring, thinking about the fact that these are existing businesses. And I would like to say one final point before the case study. Climate finance is not, for me, I always say it's not something new, because particularly when it comes to decarbonization, if you have a manufacturing company, a processing company that has been in existence for 10, 15, 20 years in our various countries, that is currently burning serious fossil fuels. Hello, can you please mute if you're not speaking? Thank you. So, for example, that kind of company on the continent or any country in Africa, burning fossil fuel, particularly diesel, to manufacture. And they're also having to buy generators, they have to depreciate, they have to maintain. And you have a clean energy company that wants to help that company switch from fossil fuel to clean and energy efficiency that is cheaper to them. Now, a commercial bank might say, yeah, what is the collateral in that case? But the point is that this manufacturing company is an existing company with over a decade in business operating so well. The component that we want to decarbonize is what is most essential for this business. So meaning that a majority of times when we're switching from dirty to clean is actually cheaper. It's cheaper based on the kind of funding that the bank or whatever is able to fund. It has to be a 7, 5, 10-year funding so that you are able to set a very reasonable and affordable tariff for such manufacturing company. In that case, for me, I always say, what is the point of collateral? Because that company will pay back. The company has a good balance sheet. The company has been in existence for 10 years, producing food and all those stuff. So why collateral? So we should have to be very careful. At what point do we ask for collateral and what kind of collateral? And finally, we need to start to define what collateral is. It doesn't have to be a property or guarantee. It could be a structuring, a ring fencing that will provide that comfort that the fund provider needs. Okay, so case studies, Moses, if you don't mind, I would like to take like 2, 3, 5 minutes just to get reflections before we go into the case study. Thank you, Moses, if you don't mind.
Okay, go ahead. Yeah, go ahead. Go ahead.
Okay. So to the audience, do you have any reflection? Because now we are going into case studies, which I will also walk us through.
Hi, can you hear me? Can I come in? Hello.
Hello, we can hear you.
Good afternoon, everyone. Calling from Nairobi. This is Olufunso Shumarin. I work with the bank based here in the regional office.
Your connection is very poor, Olufunso. Your connection is very, very poor. Maybe you can send your comments through the chat. Any other person that wants to say something?
Is this better?
Okay, go ahead, try it. Let's see.
All right. No, I think it's a very quick comment. We have a very special scenario in the African context, and it is that those who have money, we keep telling you we can't find good projects to invest in, and those who have projects keep telling you we can't find money. And these two people exist in the same environment, in the same ecosystem, trying to achieve the same thing. And oftentimes, and I feel the disconnect is largely around our understanding of what we consider to be bankable. And it's, I definitely just want the speaker to reflect on that, because there's a mismatch between the demand side and the supply side. And when you talk to most people who are project developers, what they consider to be bankable is not necessarily aligned to what the investor considers to be that. And we need to be able to deepen our knowledge about what is the investor looking out for, what makes a project an attractive option for an investor. When we say something is investable, what does it mean? Is it just proof of concept, or is it something very much on the financial side? I think that mismatch has really led to a lot of, unfortunate situations.
Okay, then thank you very much. Dr. Jubril, I hope you got what he said. If you can summarize for those of us who didn't get a bit of some of the things he said due to this connectivity.
Okay, yeah. Dr. Fulusho, thank you for that. Thank you for that question. I mean, in some way, what it just asks is that in terms of project origination and structuring, we have to look at it from different lenses, right? So there are some projects that developers are so passionate about and they believe they're bankable, or even NGOs or even impact investors. But if the commercial bank or DFI looks at the same transaction, they will say it is not investable, and vice versa, actually, right? So that is a very, very key, very, very important question. But the way I always respond is this, right? The way I always respond is that it is not, from my own perspective, from my own experience, I don't think that a bankable transaction is defined by those that want to fund it and those that are actually managing that transaction. Can I give you a very simple scenario very quickly? So let's say I'm an impact investor, okay, but I want to do a mezz or a debt financing, and my investors are only interested in 3-4 year financing, okay? And I have a mini grid operator that has a good bank business model, but the kind of capital that is needed probably 7 years or 10 years or 6 years, okay? Now, to me, I would say it's not bankable because I'm working with a 3-year funding for me to exit. And that way I will put so much pressure on the price point of the business, and then that business will not be able to be attractive to their own customers. So again, everything still boils down to really the SMEs working with their various advisors or banks, whatever it is, to be able to dissect and understand the business model of that business. And from that understanding, they are able to understand the kind of financing they need, the kind of fund structure they need. Is it equity? Is it long-term? Is it constitutional loan? That is also very important before they now start engaging all those various investors. And I always say one thing: if an investor says the transaction is not bankable, doesn't mean you are the problem. It does mean that the investor has other things they're looking at and not your business. So don't feel too bad about it. So that's what I would say. So that's why I'm always saying collaboration is very important from the starting point of originating the transaction, so that all the parties are part of it, are co-creating the business model and ensuring that that thing works. Okay, any other comment before I proceed to the next to the next side of the presentation?
I think you should proceed, And during the Q&A session, we can take more. Yeah.
That's fine. So there are about 5 to 6 questions. I will just go through as many as you can. How many minutes do I have left?
You have less than 10 minutes.
That's fine. So look at this transaction, everyone. This is a captive hybrid solar power transaction for an agro processing plant anywhere in Africa, for example, okay? This processing plant, let's give an example, has been in operation for 20 years, 15 years, okay? But they're having issues with power, having to borrow money to buy generator at, let's say, 20% from a commercial bank. They have to buy diesel that is always increasing anywhere in Africa. You know, they have all these issues. Now, there's a solar company that is saying that, hey, I can provide to you power as a service. You don't have to own these assets. I will just come to your system, install the panels, have a backup generator, public gas generator, have my batteries, have my inverters, and you pay me X tariff every month for the next 5-7 years. Okay? The user of the energy is what? An existing business. So if I was a DFI or a commercial bank, how do I finance this? First of all, the money must be nothing less than 7 years with its funding. So if a commercial bank doesn't have money of that kind of maturity, they need to go to a DFI to say, can I have your constitutional loan for 7 years or 10 years? That's one. The second thing is this. Now, this solar company has been in business for, let's say, 7 or 8 years. Yeah, you may not trust it, but the thing is that solar company technically competent and sound? Do they understand the solar technology? Can they install it? Can they operate it? Do they have a track record of installing solar in the past? The answer is yes, fantastic. Now, we now ask ourselves that this tariff that will be paid every month by this off-taker, by the agro processing plant to the solar company, is 70% or 60% or 65% of that tariff. Will it be enough to pay back the money from the DFI at, let's say, 10% or single digit for the next 7 years? If the answer is yes, for ladies and gentlemen, to me, that's bankable. Now, if the bank now says, what extra comfort do we need? Now, an AGF will willingly, African Guarantee Fund will be willing to guarantee such transaction partially. And why partially? Because this is an agro-processing plant that has been in business for 20 years, doing so well. They just want to also support the climate agenda of decarbonizing their processes. You know, so that is the kind of financing that we can look at. We can blend either the conditional loan for 7 years with a guarantee to partially guarantee the bank's involvement, you know, and then do a 7-year funding. For me, that is a bankable transaction, right? Even without an equity investor coming into this transaction, because this business is already an existing business, you know. And the other way around, the business can come directly to the bank to say, you know what, I'm not going to do power as a service. I want to buy the solar equipment, all those clean energy assets, and own them as a capex. Can the bank please finance the capex for me over the next 7 to 8 years? Because, so again, that will not be a corporate finance on the cash flow strength of the business itself. So these are the kind of ways we can look at these case studies. And these are the low-hanging fruits right now, because the issue of decarbonization is not about funding a new sector. It's about decarbonizing the existing sector that are currently carbonizing the entire economy. So that is just what the story is about. You know, a large renewable energy project, again, how do you want to finance this? This kind of company has a massive portfolio already, and they want to finance a new project, okay? So the question is this: do you want to finance them on the back of their existing cash flow as a balance sheet financing, or do we want to securitize the existing portfolio, or do we just want to have an XPV for this new set of projects? You know, so these are the kind of things that we need to look out for. This kind of transaction, a PE funding is very, very key to blend with the funding from the commercial bank or DFI or AfDB, whatever it is, conventional loans, blend that together with a PE fund or FC fund. And again, not necessarily a grant, but a technical assistance from an NGO like GIZ, DFI, USAID can also come in here to build capacity of the project developers in terms of financials, bookkeeping, entrepreneurial and corporate governance. That's another way to also crowd, because this is a very large project and you cannot make any mistake. So we need to be able to de-risk every process of that entire transaction from the project side as well as the enterprise side. So that is kind of collaboration that should come to the fore for this kind of large renewable energy project, because collaboration is just so important. And that is what we've done in our own project live in Nigeria. Mini-grid, I think I've given an example of the mini-grid case. Mini-grid needs to be blended with, I always say, DFI or donor involvement. A lot of donors funds are out there supporting mini-grid. We have GIZ, we have UKHEAD, we have AfD, we have so many of them that are pumping grants, pumping TA to build capacity of solar companies to be able to focus on building mini-grid in the rural communities in Africa. Because, rural communities are very, 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 very funny, because these rural people are not, the purchasing power is not as strong as the urban or commercial business like the agro processing company. So there's a need for de-risking. So that kind of technical assistance, that kind of grant to buy equipment, to do whatever it is also a key injection. And at the end of the day, de-risking can be done. This is a case where, again, guarantee can also come in this case, to guarantee maybe an higher guarantee cover, not 50%, maybe 75%, because it's a more risky end of the market. So that is the kind of blending that I see in a mini-grid project for the continent, for us to be able to mobilize capital locally and internationally to make this transaction really flow. And there are a lot of pipelines for that. So quickly to sustainable agriculture. Now, this is a navigation system. For those of us that know, there's something that is called an agro scheme, meaning that you have an agro processing plant somewhere that wants to aggregate smallholder farmers in a village, okay? And they're meant to produce or harvest a certain specification of the crop so that the processing company can use that to process and produce food for people to eat. Now, a major concern we all know, the most vulnerable sector to climate change, like we all know, is agriculture, because of this growing drought and desert encroaching, in various parts of Africa, actually. So, but again, there's droughts, but population is increasing. There's more stomach to feed. So we have no choice but just to get innovative of how do we start producing food in a way that is climate resilient and climate smart. So the question here is this: how will a bank or a DFI finance such agro scheme of money going to smallholder farmers to cultivate rice paddy, for example? And they have to play into how do we finance solar irrigation for these farmers, whether if it doesn't rain or there's drought, how do we ensure that there's constant water supply for these farmers so they can produce the yield and specification rather for the rice, rice miller? So for me, again, DFI, look, there are a lot of government partners, NGOs like Aiafd, GIZ that are doing so much research, so much grants into this area of drought, right? These are the kind of partners that commercial bank, DFIs needs to constantly engage, because they've done a lot of analysis. I know you cannot de-risk without fact and data. They have all these facts and data. And at the end of the day, what these smallholders want to do is just be able to produce, for example, 99.9% of what they're meant to produce. So my point is that imagine if we don't finance the solar irrigation, the smallholder farmers will end up producing less than 50% of what they're meant to produce, and that will affect the entire transaction. So investing in such, ring-fencing it and investing in solar irrigation is actually more to safeguard the investment and to ensure that the expected yield and value is protected. And once that is achieved, the money that will be used to pay back the financier of that irrigation component or the value chain will always come, because the value that is being created, people are making profit because the expected yield is achieved. So a lot of grants here, guarantees absolutely, equity not necessarily for equity here, but guarantees, commercial bank blended with concessional loans is something that will really work strongly in this instance of solar irrigation. Greenhouse farming, for me, I always say greenhouse farming is just like financing, for example, a ShopRite or any big company that is into buying and selling of tomatoes, right? For me, a commercial debt can do this transaction. Absolutely, guarantee needs to be involved, equity needs to be involved. But in this case, there is no need for any grant, because urban farming, greenhouse farming are existing companies, largely that they have their own. There's also shareholder. There's also owner equity in the transaction. There's already a captive market that will buy the vegetables or perishable products for them to consume. It's just for us to get capital, commercial debts, equity into that transaction. Most of these guys don't have properties as collateral. Some guarantee also will make sense in this instance. Partial guarantee will also make sense. A five-year maximum tenor will be okay for this kind of transaction with greenhouse farming because the market is there. People will always, tomato is the most consumed agro produce in Africa, or even in the world. Okay, so the market is there. The key thing is the price point, the funding, the equity, and then we can scale. So that's how we recommend that we structure this, thinking consciously. If you look at everything I've said, blended finance is critical. So the equity there is not necessarily that if the owner of the company does not have equity, this is where the bank, DFIs must also have an equity partner, VC partner, a mezzanine partner that can always come in here that are already aligned with climate change, that focus on sustainable financing to crowd them in from the very, very start, so they can then fund this transaction. Because if you bring them in the middle or at the end, nobody will invest because nobody will understand the story and the effort that you put into that such transaction. Solar powered cold chain. This one, again, NGO, impact investors have done a lot of research in this area. Again, with data, we can de-risk. With data, you can know the transaction well. Because, commercial banks like the DFIs always don't like to invest in transactions that all of us don't like to invest in what we do not understand. So what this partner with NGOs is very, very important. A guarantee is almost important in almost all the transactions because most of all these transactions might not have collateral there, but there are some that have collateral. So I give an example. The very first case study, the agro-processing company that is very massive for 15, 20 years will have collateral, either a debenture on the equipment. So in that case, there's really no need for any guarantee if it is a corporate finance. So corporate finance, project finance should guide us on how we structure transactions. That will also define how the kind of comfort or collateral to ask from them, because the collateral you ask for a corporate finance is different from the one you have for a project finance, particularly when you're referencing the project finance. So that's the kind of innovation I always put into this. And my final point is this, I always say this, that there's no one way to finance all this project, okay? It is the peculiarity, the complexity, the partners you bring into every transaction or at the point of origination that will determine the kind of financial instrument to introduce to de-risk and to ensure that the transaction does not fail. I always say this is more of financial science. How we just we're like a financial chemist, okay? So we have all these financial instruments as the various chemicals, right? So we have which chemicals to mix together to mix together based on the diagnosis of every transaction. Can someone please mute that for me? Someone distracted. Thank you. So that's where I see all of us need to be that kind of chemist, based on diagnosis, working with various partners, understand the transaction. At the end of the day, we want the transaction to succeed. And by succeeding means that the right team must be on board, the right finance must be on board. There must be a market that wants to buy whatever that climate solution is producing or service that is selling. That is very, very important. And in most cases, the market is always there because what climate finance is about, what climate action is about decarbonizing an existing economy or sector. And climate adaptation is about how do we strengthen, how do we safeguard and make our sectors resilient to climate change impact. So I will stop here and wait for questions and specific technical questions and I can build on from there. Thank you so much. Boss, is over to you.
Yeah, thank you very much, Dr. Jubril Adeojo. There were some direct questions that came in, which I think probably you want to handle before we take some few minutes break for Professor Fobisi Kalame to start his presentation. Now, one of them is from Dennis Diagratias. He said, who bear the cost of the guarantee? Because I remember you kept talking about yourself and Stalin was kept talking about guaranteeing the risk and things like that. He's now asking who bears the cost of the guarantee. Now,
the SMEs.
The SMEs, okay, great. Now, there's a second question here. Say, how green are the pension funds in Africa? This from Boyega Olorunfemi. He said, how green are the pension funds in Africa? Take Nigeria, for example. Does the Pension Act allows it to place money in green finance? Dr. Adeojo.
Yeah, the answer is yes. Pension funds are the largest subscribers to the two green bonds of the federal government of Nigeria, the sovereign bonds. They're also the last investor in the Access Bank green bond 2 years ago. Also the largest investors in the North-South Power, Hydro Power green bond last year, even this year as well. So yes, the answer is yes. SEC has already approved a green bond rules. You know, there are other Ghana, Kenya, Rwanda, Uganda, all these countries working with FSD Africa. They've worked with our various SEC to define green bond rules to build capacity and ensure that pension funds and other institutional investors locally are interested in this climate finance. And finally, everybody now understands that climate change, climate risk is the next pandemic coming. So people must ensure that the asset class are climate smart, climate resilient. Yeah.
Okay, thank you. There's one from Elvis Iyamu. Elvis Iyamu say, Dr. Jubril, the agro processing is a good case study. Just a little tweak. How would you view it if it were a startup in a growing market?
Very good question, right? So like Funshaw asked earlier, like Dr. Funshaw asked, the first thing is if it's a startup, you know, the point is how many years has that startup been in existence? Okay, is it at the minimum viable project level? So if it is at that level, then maybe you still need more grant, more equity, and not the commercial debt, right? Because you need to be very careful. You know, startup is not even about the sector where that business is operating. It's the fact that it's a startup and that company might have corporate governance issues or any other issue that is not even related to the project that could kill the transaction. And that has to be built over years. And what can build that can have that kind of patience is that you leverage on more grants or you just leverage on more equity the 5 years to build or to show the market that you're there to stay for 5 years to 7 years before you now start leveraging on such commercial debt. So it depends on the kind of investor that you're talking to, but I recommend equity investors and more impact investors and donors.
Okay, Dennis Diagratis is back. He said, if the SMEs bears the cost of the guarantee, how does that affect the viability of their project?
Good question. You know, first of all, guarantee is an insurance premium you pay. It's an insurance, okay? So usually guarantee is less than 0.51%. Okay, of the money you're borrowing. Okay, so if you're borrowing money at 10%, guarantee is just going to add additional 1% to it or 0.5% to it, and that should not kill the transaction because that is why the business model and the financial model must go into proper stress testing to be sure that the right point, the price point is critical for the business to the market. So that is not a problem because the guarantee price is very affordable, and it's also on the reducing balance sheet. The more you pay back your principal, the lower it goes throughout the year of the funding.
Okay, thank you very much, Dr. Jubri Adeojo, for a great session. You've done very well, and I'm sure a lot of the participants are quite happy with your contributions. Now, we will take a break for about 2 to 3 minutes. But while that is on, I would like to call on Professor Fobisi Kalame and Barrister Titi Akusa to begin to prepare for their presentation. They can share their slide. Barrister Titi Akusa is a gender risk expert, while Professor Fobisi Kalame is a risk and finance expert. So while they prepare for that, that will be for Module 12, which is on Introduction to Green Climate Fund and Green Proposal Development. Introduction to Green Climate Fund and Green Proposal Development. Thank you very much. While we are waiting for the next 2 to 3 minutes, and we'll take over.
So, Chris, what you mean now?
Please switch off your mic, mute your mic, mute your mics, mute your mics, please. Mute your mics, please. So, Prof, I think you should switch to presentation mode, switch your slide to presentation mode.
Thank you very much. Can you see my slide?
Yes, I can see your slide, but switch to presentation mode like you did much earlier.
Is it okay now?
Switch. You go to your top left. Yeah, it's okay now. It's okay now.
Okay.
Thank you very much. So you have the floor. You have the floor.
Okay, thank you very much. I am Kalame Fobisi. So I work on various climate finance and climate change issues, both adaptation and mitigation. So today I'll be giving a very brief generic overview of the GCF, the Green Climate Fund, but also a very introductory presentation on the grant proposal development, specifically in the context of the Green Climate Fund. In between my presentations, we shall also have Barrister Titi, who shall say something about gender and climate finance. Now, I know that most of you here are already very familiar with the GCF, but you know, I'll quickly go through this, and I'll be happy to discuss further on any particular or specific issue that might arise. So, basic elements of the Green Climate Fund. It's found in South Korea. It's the financial mechanism under the United Nations Framework Convention on Climate Change. It was established 11 December 2010 during one of the Conference of the Parties meeting in Cancun, Mexico. And the members are the 194 member states under the Climate Convention. In terms of governance, it has a board, a secretariat, and an independent unit. The mandate is to promote climate smart development, both in terms of emission reductions and climate resilience. So how do we engage with the Green Climate Fund? At the level of countries, they have the National Designated Authority or focal points. It can be an individual or an institution, as we see in many African countries, that engages on a daily basis through different communications with the Green Climate Fund. And they have the Strategic Country Program, which also clearly outline areas where the country wants to engage on with the Green Climate Fund. And most countries will seek or identify accreditation of entities to access the resources from the Green Climate Fund. They will also develop projects. So we have situations where countries will take the initiative to develop their own projects and look for accredited entities to submit to the Green Climate Fund. But we also have several examples where the accredited entity will develop their own projects and then engage and coordinate with the countries to submit the project. So in terms of the financing architecture, we have projects and programs that are developed or facilities that are developed by accredited entities. And the accredited entities, they now submit these to the Green Climate Fund for financing. And as earlier mentioned by previous speakers, the key financial instruments under the GCF, we have grants, loans, guarantees, and equity. We also have this crucial role of the national designated authorities and all focal points. They convene the national stakeholders. Climate change project involves so many different actors at different levels playing different roles. The communities at the implementation level, who are also the beneficiaries in most of the projects. We have the civil society, who are also part of, involved in implementing some of the monitoring and oversight of the project on the ground. But you have also different ministries and sectors at the national level that are often directly involved in the project. And most accredited entities, if not in the case of a private sector project, they will engage directly with the government ministries in charge through the national designated authority. So it is still the national designated authority that drafts and nominate letters for direct access. They are the ones who provide no objection whenever an accredited entity wants to develop a project within the country. And they also follow up on readiness support in terms of capacity building, national adaptation plan implementation, and many other strengthening of stakeholders within the GCF process. And they also provide strategic oversight aligned to the national priorities of the country, especially in terms of national development priorities. So these are some examples of accredited entities that we know. There are many of them, but we have two kinds, those that have direct access and those that have indirect. Direct access for countries can have direct access to GCF funds through their national accredited entities or through their regional accredited entities. Example in Africa is the Development Bank of the Southern Africa or the West African Development Bank. Those are regional accredited entities that countries within those regions can pass through to have direct access to GCF funds. At the national level, increasingly we are seeing a lot of African countries having their own national accredited entities. A very good example is the Centre de Suivi Écologique in Senegal, but there are many of them spread across different countries in Africa, especially in West, Northeast, and Southern Africa. Central Africa still has very few or much work to do in this regard, but all the regions are doing quite well. At the international level, where countries want to access GCF funds indirectly, they want to use the big guys, the big banks, the big organizations. Here we are talking about the African Development Bank, the World Bank. We are talking about the Dutch Bank, European Bank of Reconstruction. We are talking about Aiafd, UNDP, UNEP, and so on. There are many of them. As earlier mentioned, roles and responsibilities of accredited entities. They prepare projects, programs, and facilities for funding by the GCF. But they do that in close collaboration, communication, engagement with countries to ensure that the countries feel comfortable, they own the process, they own the project. So they need to respect country ownership. And the accredited entities, they are also responsible for project appraisal, structuring, supervision, and evaluation. And they meet the reporting standards of the GCF on how the project is faring. Still within the context of accreditation, you see that to become an accredited entity, there are a couple of areas that you must show that you have the capacity. First of all, they want to look at your fiduciary functions. They want to look at how much good you are in terms of respecting environmental and social related issues within project implementation, but also looking at how much of a project have you been managing or you can manage. It's important to note that in the context of the GCF, we have the micro projects, which are less than 10 million US dollars in size. Then the small, that ranges from 10 to 50 million US dollars. Then we have the medium-sized projects from 50 to 250 million. Anything above 250 million US dollar is large project within the context of GCF. And a lot of accredited entities, especially those that are national, don't have the capacity to manage very large projects. Very few of them do have, especially in Africa. So you see a situation where accredited entities, both for direct and indirect access, are not competing, but they should be complementing each other, because a project that can be handled by the African Development Bank might not necessarily be handled by Centre de Suivi Écologique, because maybe they're not able to manage funds above maybe 250 million USD dollars. So this is an area where there is some overlap and complementarity in terms of implementing projects. In terms of resource allocation and the framework within the GCF, we realize that even though as per the convention, the developed countries need to mobilize 100 billion annually, beginning as from last year, even though that is the expectation, that is the plan, that is what is expected of the developed countries, the reality on the ground is different. What we see today is that at the level of the GCF, 10.3 billion US dollar has been pledged so far as of today, or as of February 2021. Out of this 10.3, we have 8.4 billion that has been committed. Currently, the GCF is implementing 5.6 billion US dollar worth of projects and has disbursed so far 1.9 billion. In general, we have 174 projects already approved and are being implemented, and the total worth is 30.4 billion. Take a look. At the level of GCF, we have 10.3 billion pledged. But what we see today is that the total project, the worth of the total project that is being implemented under the GCF is 3 times that amount, 30.4 billion, which means that a lot of money is also coming from different sources, especially from the private sources. And notably within the context of renewable or energy related projects. Within the convention and within the GCF, it has been agreed that the resources shall be split equally in terms of financing adaptation and mitigation projects, 50-50. That is the expectation. However, reality sets in. As most of us already know, mitigation projects are more attractive for investors. They are more bankable, while adaptation projects up to date are really struggling to make a strong business case. And that is an area where we need to do more work in Africa to make sure that most of our adaptation projects have strong business cases, rather than, as we see from most African countries, most of the adaptation projects are focusing on grants, kind of free money. And most countries are not taking the initiative to have a mix of these different instruments, grants and loans and equity and so on. So this is where a lot of work needs to be done in terms of bringing a little bit up the level of adaptation projects in the continent. So in terms of the kind of projects or investment areas within the context of GCF, we have 4 under mitigation and 4 under adaptation. Under mitigation, the 4 areas that the GCF will finance are projects related to energy, to transport, to forest and land use, but also building cities, industries, and appliances. Under adaptation, we also have 4 areas related to food security, water security, and health related issues. We also have a rural development that cuts across livelihoods of people and communities. We also have the various services provided by ecosystems, notably forest ecosystems. Then we have, lastly, under adaptation, infrastructure and built environment. So these are the 8 areas that GCF will fund projects. And most of the projects can focus on more than one area. It can also cut across adaptation and mitigation. The example presented by the previous speaker demonstrated that clearly in the case of agro-processing units, where there are components of building resilience, but there are also components of using solar panels. So that is a classic example of a cross-cutting adaptation mitigation project. As earlier mentioned, most of the funding within the GCF projects are also coming outside the GCF, from outside the GCF, and the private sector has a huge role to play in this regard. And in recognition of the crucial role played by the private sector, a dedicated facility has been set up just to promote the private sector, called the Private Sector Facility. It was created to mainstream the private sector into climate change mitigation and adaptation. What type of intervention will this facility make? They will fund climate risk assessment models and tools. They will also cover long-term debts, liquidity, backstops, and refinancing. They will also look into equity required to develop a project to full bankability. They will also provide guarantees to bear specific risk to entice hesitant investors. And in terms of how the private sector can access this facility, they can do that through financial intermediaries that meet the fund's standards, through accredited entities, or through special requests for proposals. And when it comes to private sector, we are talking about SMEs in Africa, and this is a very, very challenging area, because we realize that the SMEs in Africa, majority are family-owned, family-led, and they are quite small, micro and small, and it becomes much more challenging for them to scale up or to access funds at certain levels. At the level of GCF, scale is everything. They want projects at scale. They are not interested that much to go after very small initiatives. And that might be an area where intermediaries come in, private financial institutions come in to liaise directly with SMEs. But generally speaking, in Africa, they are dominated by micro and small enterprises that will not have capital up to $500,000 US. And that is a real challenge which needs to be looked into critically. So that was a very brief rundown of where we stand with GCF. There are many other things that I could have shared with you on GCF in general, but time constraint, I just pick a few slides to share with you. At this point, maybe I will give the floor to Barrister Akosa Titi to come in and say something about gender in the context of climate finance before I continue with the second part of the grant proposal development. Barrister.
Yeah, thank you very much. That's a wonderful presentation you have just given to us, and I think it's so much okay. And I think I can pick up from there. And I think it's also very important that I speak in the context of what you have also presented concerning the GCF. And it's also very important for us when we're talking about financing and gender and how the GCF has also helped the financing landscape in terms of introducing gender. If you have listened to what the presentation very well, you see the structure of the Green Climate Fund. But one thing that is very important with the Green Climate Fund is that it's the first climate funds that started out with gender. If you look at all other climate funds, like the Adaptation Fund, and then some of the funds at the World Bank, you will see that a lot of them, of course, retrospectively started mainstreaming gender into their climate finance and some of the finances they are dishing out on climate change. So for the GCF, it was very intentional at the beginning to have a gender, and it was in the documents that the background documents of the GCF. So, and it's in the principles. And if you look at paragraph 3 of the GCF, you will find it there. It talks about the fund will strive to maximize the impact of its funding for adaptation and mitigation and seek a balance between the two while promoting environmental, social, economic, and development co-benefits and taking a gender-sensitive approach. That is the key word there, a gender-sensitive approach. And over the years, since about 2015 that the GCF has started, they have gone to expand what they mean by a gender-sensitive approach. So what does this gender-sensitive approach mean? It means that the fund is mandated to mainstream gender in all its activities, either at the institutional level or at the project level. So both ways, you must be sure that they're taking account of gender issues and ensuring that whatever they do is gender responsive. So even if we look at some of the things that have happened from 2015, they had what we call a gender policy and an action plan for the GCF, which also talks about ensuring that there's gender balance within the institution, and when they are having their proposals and projects, and they must also mainstream gender. And down the line, since 2015, also we've had a situation whereby GCF now insisted that project proposals coming to the GCF must have a gender action plan. And that's a very good starting point also to ensure that all that we do that is done in the GCF also think about gender. And looking at DFIs, you also understand that a lot of DFIs have been accredited to the GCF. And I think most of them, if you check the GCF website, most of them are international accredited entities. And pushing the frontiers of gender within the GCF now means that DFIs are trying to accredit with the GCF also must have a gender policy and a gender action plan. And this is something we've encountered engaging with the GCF. I remember when the Dutch Bank wanted to get accredited to the GCF, I think when they wanted to have one of their first project proposals, which is from the private sector facility. And it was there that we at the civil society level had an engagement with them to discuss with them the level in which the private sector facility is going to go. And some of the important questions we asked was about gender. How are they going to make the finance gender responsive? And it was like, how do we do business looking at gender? How do we put gender lens with doing business? So it was a question that they have to push back to us. And we rose to the occasion and we said, for some of these funds that are going into your hands, can we look at putting aside some part of it to ensure that women benefit from these funds? Apart from that, we could look at some of your financial products that will have a good effect on gender equality. How does it promote gender equality? So there are different ways of having this gender lens in terms of investing. So for the GCF have really progressed a lot around gender. We have a gender action plan. Now, every project must have a gender action plan. And what does that mean? Having a gender action plan means that you must, first of all, look at the gender aspect of your project that you are bringing to the GCF board. And then looking at it, it means that you must have what I call gender targets. Go inside your gender action plan. When you have a gender target, you must also look at your indicators. What are the indicators that would tell us that, of course, your project is also addressing gender issues? So, for instance, now, if you say you are going to get some funding to do maybe solar projects in any African country or any other country whatsoever, we want to also know whether those who are going to benefit, how many of them are going to be men and how many of them are going to be women. And then in terms of the products, are the products you are going to be deploying gender responsive? Does it take account of what women need in terms of their day-to-day activities and work that will help them to reduce gender inequality? Those are some of the important things that the PPF will also be looking out for when you are doing your gender action plan. So these are some of the things that we have been taking up, and it's something that is very, very important within the GCF, so that you must also know that if you don't have what we call the gender action plan, then your project won't scale through. That's the basic for the GCF. So I want to divert a bit now, maybe just 2 more minutes or 3, so that maybe at the end of the GCF grant proposal development, I might also come in with a few issues. And looking at what DFIs have done, and I know that within the AfDB, they have done a lot around gender, which it's around AFAWA. I know that is affirmative action in finance. And we also know that there are other organizations who are also looking at genderless investments. Now, looking at investment with gender lens. And with some of these presentations we've had this morning, it's also very important we also start looking at where are the gender issues within what we are putting before, looking at the value chains, how finance flows, how finance is deployed, how do we ensure that they're all gender responsive? And there are important critical factors that we really need to also understand when we're talking about genderless investment. And one of them is how does it demonstrate gender equality throughout the value chain? It's very, very important for us. That is if we really want to focus and ensure that our financing also as a gender outlook. Then again, for some of the people that we are looking out for in terms of beneficiaries, are we looking out for a particular quota for women? And then are we also focusing on women-led organizations and women-led, what do you call it, SMEs or whatever businesses, really? Then are we looking at some of the services that will be deploying some of these finances into? Are there services that have a positive impact on women? And then how does the structure of your business also, we might also be looking at businesses that have more women in their structure. And then how does our funding and financing also work to dismantle structural gender inequality? See, these are some of the important things that we really, DFIs really need to look at. And I think some DFIs have been taking this up and even expanding the frontiers. And I think it's also important for us to also consider some of these things in most of our presentations in terms of looking at gender mainstreaming and also how we reduce gender inequality, because at the end of the day, by 2030, I think we have some targets we have to meet when it comes to gender equality. I think so far for now, that's what I have for my intervention. Maybe after this other presentation, I can come in with just some 5 minutes overall overview some of the things I've had here and put in some important aspect from what I've had here. Thank you very much.
Thank
Hello?
you. Hello.
Professor, please go ahead, please.
Thank you, Barrister Akosa. You were just spot on. I also want to say that gender is like something you cannot do without. So we need to completely shift our mindset. Whatever thing we do, we know that gender is in mainstream at all levels, vertical, horizontal. And in addition to gender, which is one of the key asks from the GCF, there are also other important issues that needs to be presented or assessed. In addition to gender assessment and action plan, the GCF will require projects to also provide an analysis or report on indigenous people and their rights, or local communities where indigenous people don't exist. And if it is being contested, or if the law does not recognize them, the GCF might still recognize them. So these are all tricky areas that needs to be looked into. Another key area is social and environmental safeguards, which needs to be reviewed for each GCF proposal, as well as risk-related issues. But this is just a couple of minutes presentation, which cannot delve into all these aspects. We know that at the level of grant proposal within the context of GCF, we have the simplified approval process, which is known as SAP. These are projects that are up to $10 million US. And this has been one of the ways where many African countries have quickly accessed GCF funds. But in addition to the SAP projects, we have the normal projects, funding proposals. So I'll be talking more on how some of the key things that we need to do to get to these projects approved. And I might also draw a little bit from some of my experience reviewing a lot of GCF projects, but also preparing projects for different accredited entities. How to prepare a project proposal within the context of the GCF. After gaining accreditation, the accredited entity will develop their project program or facility for funding in one or more of the 8 sectors or areas that I earlier mentioned: 4 under mitigation, 4 under adaptation. The accredited entity must liaise, engage, communicate, work, collaborate closely with the national designated authority who is in charge of providing a letter or a note to the GCF called no objection note, to say that they are okay with this project and that is something they want to be part of. And then the GCF will now evaluate your proposal based on 6 different criteria. And these are the 6 criteria that the GCF will use to evaluate all their proposals, all proposals that have been submitted. So they will look for impact potential. Impact here is in terms of adaptation impact or mitigation impact. When it comes to adaptation impact, if you look at the GCF result framework, most of the time, the indicator is in terms of how many people this project would directly impact positively. And in terms of mitigation impact potential, here they are looking for emission reduction potential of the project activities. How much emissions will be reduced, or how much carbon will be sequestered through your project activities. And that is how they will evaluate your project in terms of impact potentials. Paradigm shift potential will also be evaluated And this is basically the potential to catalyze impact beyond a one-off project or program investment. And most of the time, the paradigm shift can be at the policy level, but it can be also at the sub-national level in terms of how it changes the way people do things. Sustainable development potential. It will look at the different pillars of sustainable development, social, environmental, and economic, and how the project will contribute towards these different pillars of sustainable development. And sometimes this can be connected directly to the national development priorities. Needs of the recipient, the beneficiaries of the project, those who are vulnerable in terms of adaptation projects. They will try to assess whether the project activities will help to increase the adaptive capacity of vulnerable communities or ecosystems or sectors. But also the financing needs of the recipient country. Country ownership. You will need to demonstrate in your project how you engaged, communicated with the country where the project is being implemented in. You will need to show, in some cases, reports of consultation to get input, feedback, brainstorming sessions from stakeholders within the project area or within the country. It can be at the project location or at the national level. But there are different ways that you can use to demonstrate country ownership. Efficiency and effectiveness. GCF is very keen to make sure that the cost that you allocate to different activities, they make sense. They are comparable to other similar projects in similar contexts. We have situations where a project on tree planting in country A, to plant one tree costs $5, while in country B, it costs $20. And majority of the countries, it costs $5. So you coming with a proposal of $20 in terms of the cost of planting a tree does not make sense. So the GCF is looking out for all these. And generally, the financial soundness of your program or project or facility. So all projects will go through a screening using these 6 criteria. In terms of potential investment priorities, we are seeing more and more projects using the clustering approach, where their activities are touching more than one of the 8 investment areas of the GCF. And in many cases, they are having both mitigation and adaptation objectives or activities. In some cases, the project will project more of a mitigation, let's say a renewable energy project, will project more of mitigation outcomes, and will be written or prepared in a way that evaluations will be based on the mitigation objectives. However, within the project, you will find some secondary objectives or low-hanging fruits or benefits, maybe adaptation benefits, which are not directly quantified or monitored within the project. So in this case, it will be a mitigation project. But that same project can be written in a way that both the mitigation and adaptation objectives are presented officially and having the same or similar level of attention, even at the level of budgeting. So, but this is an example of a project on a transport, which will cut across mitigation, but also having some links to do with infrastructure and built environment related issues. Remember, 4 projects under mitigation on transport, energy, forest land use, and equipment and cities. But the other 4 projects on adaptation are cutting on livelihood, rural development, food, water, and health security issues, but also infrastructure and built environment, as well as ecosystems. So this is an example of a transport project that cuts across two different adaptation areas of GCF investment, namely livelihoods for people and community and infrastructure and built environment. This is another example of a project that can be developed with the intention of meeting food, water, and health security objectives, as well as providing different ecosystem services. At the same time, this project might have the potential to reduce emissions, hence mitigation-related objectives. It is now up to you to define or develop or prepare your project in a way that either bring both mitigation and adaptation objectives for evaluation by the GCF, or you project rather one, in this case, maybe adaptation, and then you quietly leave the co-benefits or the low-hanging fruits in terms of mitigation. But more and more people are going for both, especially in the land use sector. Yeah, I'm talking about agriculture, forestry, and ecosystem services. Again, you can have a pure mitigation REDD+ forestry project that has adaptation components related to the provision and flow of ecosystem services as a secondary objective or a low-hanging fruit. So you have the possibility to juggle with all these approaches of clustering different results. But anything that is presented as a clear objective will be monitored, will be budgeted, and will be verified and assessed by the GCF before, during, and after implementation of the project or program. In terms of how the process happens, we need to look at this figure to understand the GCF project approval process. We have 5 or 6 different steps. I say 5 or 6 because where we have step 2, which is about concept note, it's optional. You are not obliged to develop a GCF concept note. You can go straight with a funding proposal if you have the capacity and confidence of your project. But it is generally recommended by the GCF to start with a concept note. Approach them with a concept note that presents within a 12-page document what you intend to do in terms of objectives, project components, and different levels of inputs and outputs, results, and impacts. So these are the 6 different steps that you will engage in to get your project validated and funded by the GCF. First of all, inside your organization, you want to have a project idea note. It can be 1 or 2 page document. It can even be 10 pages. It is this project idea note that you maybe as soon as possible, you engage with the national designated authority, because the assumption here is that it is the accredited entity that is developing the project. So you want to already engage with the national designated authority to share this project idea note or program idea note. In some cases, the country already has some project idea notes written, developed, prepared already. So the accredited entity can also engage in with the national designated authority to build on their own project idea notes and take it up for further development. So it can happen either way. The project can come from the national designated authority, it can come from an actor within the country, but it can also come directly from the accredited entity. So now we proceed. The accredited entity will proceed with the development of the concept note. They can do it directly, or they can do it strictly in collaboration with the national designated authority, but they can also engage directly with the beneficiaries of the project. So there is no approved way of doing this. The only important thing is that there should be strong engagement with the country through the National Designated Authority. The third part of it is that once your concept note has been developed, shared with the GCF might give you a green light or give you feedback in a subtle way, whether they are happy with what you are trying to develop as a full proposal. They might give you a feedback or not. We have instances where concept notes have been submitted to the GCF and they never gave feedback. They are overwhelmed with the number of concept notes that have been submitted to them from different accredited entities and national designated authorities. So if we are lucky enough to have feedback from the GCF, then that is a very good thing in terms of helping you to decide how you want to move forward. In some of the feedback, they will straightforward tell you this one will not go through, or this component will not be funded by the GCF because of these reasons. And that is very useful. In some cases, when they give you the green light, oh, we are happy with your concept note. Now, you will have the possibility to apply for project preparation grant, which can be up to 1.5 million US dollars. So we have situations where accredited entities, once they have their concept note kind of having informal approval from the GCF, they will go for these preparation grants to develop a full funding proposal. And it is at the level of the full funding proposal that an accredited entity would officially submit their proposal with a no objection letter from the National Designated Authority. And this funding proposal will be a subject of GCF analysis and recommendation. And the way GCF operates is that they will normally use their experts. They have individual experts. They have a lot of noise is coming.
Please, can we move text? Hello, Gray.
Hello.
Hello, Gray.
There's a lot of noise.
Herodox. The noise is coming from your end. Herodox, Gray. Actually, it's them. Herodox, the noise is coming from you.
Thank you for your understanding. You know, sometimes it's difficult to work at home during the COVID period. All of us, we have kids, most of us, and it happens from every now and then. Thank you very much. So as I was saying, once the project is at the level of the GCF, they'll send it down for external, or they'll undergo, the funding proposal will undergo an analysis, and then they'll come back to you with their review or their feedback or their recommendation. And they use individual experts to analyze and provide recommendations. They also use organizations to do that. And once you receive the feedback, you have to work on them. Sometimes they reject your project outright. Sometimes, most of the times, they will give you a chance to address the comments. Depending on your capacity, technical capacity, and how organized your organization is, you can do that pretty fast and turn it around if they are not major comments. But some of the comments might necessitate full studies. Some of the comments might necessitate redoing from scratch some of the aspects within the project. And that is why before you submit a funding proposal, you must have conducted a lot of pre-feasibility studies and feasibility studies on different aspects: economic, financial analysis, projections, return on investment, risk related to the project implementation, gender assessment and gender action plan, safeguards issues, indigenous people, issues related to displacement of local population. So you will need to provide detailed reports on all of these different aspects. Once the GCF is happy with this, then the technical advisory committee will now move it on to the board for decision, and they'll give their recommendation. And the board will now provide you with feedback or whether your project has been approved or not. If approved, then you move to the last stage, which is about legal arrangements for implementation and governance and disbursements of funds and so on. So this is a very brief summary on how the process is being implemented at the level of the GCF.
Okay, Prof, are you okay with this?
Yes.
Okay. You can proceed.
Okay, thank you very much. As I earlier said, I would not be talking here about full funding proposal. I will just quickly, provide you some key elements for a concept note. This will be like a different training on its own on how to develop GCF grants. But here I'm just giving a very, I'm just rushing things to give a very broader overview of what are some of the key elements. So in terms of developing the concept note before you even get to funding proposal, you have the context and baseline that you need to clearly present. And one of the key areas which I have noticed when people are developing their concept note is that most of the project is presented as a development project. I'm talking about what we see from accredited entities. Most of their projects are developed and most of the time it doesn't read like a climate change project, but rather a development project. And that is a no-go area for the Green Climate Fund. So you need to clearly in your context and baseline, bring out the rationale, justification, without any doubt in the mind of GCF that this is a climate change project. And how do you do that? If it is an adaptation project, you need to bring out the climate rationale. And most of the time, how do you do it? You use climate change concepts, frameworks, theories to explain the situation. I have been in a situation where I review projects and you see the way they explain it, they don't use climate terminologies. So in the context of an adaptation project, they want you to talk about climate vulnerability, they want you to talk about climate risk, they want you to talk about climate adaptive capacity, they want you to talk about exposure to climate impacts, they want you to talk about sensitivity to climate impacts, they want you to use words related to flood, drought, temperature rise, they want you to show projections of precipitation over the past 30 years, over the current 30 years, but also future 30 years. So you need to use IPCC in most of the cases to make your case and your analysis. In that way, you have a greater chance to project, to show to GCF that this is a climate change project. In terms of mitigation, it's much more easier in terms of showing that it's a climate change project. You want to already make a case of how much CO2 is being sent to the atmosphere because of the current practice. And you want to justify how the scenario will change, the paradigm will shift with your project interventions in terms of reducing greenhouse gas emissions, but also increasing sequestration of CO2. And this is how you do your description and justification of the climate rationale. And most of the time, as I've said, it is recommended to use scientific concepts, theories, entry points, frameworks, especially from the IPCC, Intergovernmental Panel on Climate Change. It is highly recommended to use their frameworks to justify climate change within the context of your project. Another area which is very important in the context is to clearly align your project with what is going on in the country within the climate change arena, especially the National Determined Contribution, NDC. That will be a must for all projects if you want your project to be smart. But also the other area which must be a must is to situate your project within the National Development vision, priority. Most African countries want to become emerging nations by 2025, Rwanda, for instance. By 2030, most of the Central African countries. By 2035, most African countries. So you also want to bring that in terms of, contextualizing your project. But some people can also go far as, mentioning or aligning with NAMAs, National Appropriate Mitigation Actions, National Adaptation Plans, which are being elaborated by many countries, Liberia, for instance. So you want to bring all this into play. In the context as well, you want to upfront start to identify some of the key issues that this project will confront or is trying to address in terms of the barriers, but also in terms of the different risks that this project will need to overcome for a successful implementation. In terms of describing your project or program, most projects have project components. And most of the time you see projects having 2, 3, or up to 4 components within their projects. And when we talk about components, then it has to match with activities within each component in terms of input, in terms of expected results, and how the different inputs will result to output, then form a bigger impact within the project goal or overall objective. And this is best demonstrated through the theory of change. This is an example of the theory of change. This is the one slide where somebody reviewing your project want to quickly look and see how it makes sense, it's logical, the flow is there from your assumptions to the barriers and risks you are trying to address within the project and the activities to address these barriers. And the activities are mainly implemented to come up with results within each component or outcome. And at the end, you have a final goal or impact. So you need to present a goal statement, whether it's in the form of adaptation, mitigation, poverty alleviation. So some of the goals are not just climate-centric. Some can be carbon-centric, some can be adaptation-centric, but some can be climate and development-centric, where they are also using the project to meet some critical development outcomes related to poverty alleviation. So there are different examples. In a situation where I have a lot of time, I'll show you different examples from different countries. But this is the flow that you need to show, and it has to be logical and comprehensive. In terms of financing the project, you need to make sure that each activity, each component is budgeted. And as earlier mentioned, most of the financial instruments under the GCF are either grants, loans, equity, guarantee, or a mix of more than one of all of them. But Africa predominantly having adaptation projects are going for grants, and you cannot have a lot of grants. And honestly speaking, that is not the way forward. That is not the future if you want to access huge volumes of funding within the GCF. GCF will recommend a mix of grants and loans, different kinds of loans, and in some cases, equity, especially when it comes to the private sector. And we have to be very precise how much your project is requesting from the GCF, and you have to justify. In some projects where part of it is purely climate change and there are some other components that are related to poverty alleviation, you don't want to be asking GCF to be funding poverty reduction related activities. And that is where other sources of the project might come in to fund some of those other activities that are not clearly aligned to your climate rationale. GCF's focus is mainly on the climate change related aspects. And co-financing is very crucial. And this is the main reason why a lot of projects in Africa have not been able to move forward. My personal experience, I prepared more than 5 or 10 projects for clients in Africa, and they cannot move forward because they don't have co-financing, especially the government counterparts. Governments want to develop projects, but they don't have co-financing, or they are not ready to take some bold steps to engage, to commit, and co-finance part of their own project. And if you cannot demonstrate this level of commitment, and most of the cases, co-financing is not even more than 5% of the total funding of the project. You cannot be asking GCF to give you 100 million as a government or as a project, and you cannot co-finance for up to $1 million US. It doesn't sound right. So these are some of the small areas that people need to take very serious. Otherwise, everything will fall apart. Another important area that you want to clearly demonstrate in your project is continuation after the funding from GCF. Take most of the mitigation projects that will be going on for 10, 15 years, and even 20 years. Take a typical reforestation project. Within the context of GCF, maybe GCF is engaging within this project maybe for 5, 4, or 7 years. After that, this project needs to continue, and you need to clearly demonstrate that this project will continue. And when it comes to sustainability and exit strategies, you want to even be smart enough to provide sustainability in a very comprehensive manner in terms of the governance of the project, in terms of the financing, in terms of engagement with the stakeholders. So you want to look at the different facets of sustainability within a project. In terms of cash flow, in terms of continuation of activities after the project is no more supporting, let's say, the small or medium-sized enterprise on the ground. You want to make sure that within the time of the project gets the capacity to continue without any further support. This is crucial. And that is why GCF is not interested to fund innovative concepts that have not been proven, because the risk is high. It has not been tested and proven. So concepts that have been proven on the ground in terms of implementation, maybe after a couple of years of implementing it and showing good results, let's say 5+ years, maybe putting money into your project, GCF will be more inclined to do that, as opposed to when it's just a very innovative concept, especially from a startup community. So exit strategy and sustainability components need to be clearly presented. Other issues or areas that you need to take into account to assure the success of your project in terms of having funding from the GCF. So here are some of the key best practices based on my own personal experience. You want to use the most recent template, guidelines, frameworks provided by the GCF. For instance, the theory of change. The one that the GCF is using now, it just came up a few months ago, maybe 2020. You want to make sure that you are using that new theory of change. GCF results reporting framework, where they have their template. There is a new template to present your results. You want to make sure you use that new template. And if you are not told, you will easily fall into the trap of using the business as usual template that is common everywhere. It's online and you can get it without any hitches. But it's important to know that anything GCF, you'll find all the templates on their website. Nothing is hidden. It's just you who needs to take the time to go get the right templates. And you need to engage early on with those who are involved in the project, or those who will have a say in the implementation, especially the national designated authority. And most cases, the ministry or sector that is directly involved. For instance, you can develop a project on transport or a project on renewable energy. While engaging with the national designated authority, the project will rather concern, in terms of implementation, the transport or the energy ministry. So you already want to start to take initiative to engage with these ministries on the ground, especially if the project will involve activities from these actors from the government. Even when it is a private project, you want to make sure that it is aligned with the appropriate sector and the appropriate sectoral policies, as well as development and NDC objectives of the country. So either way, public or private actor implementing the project, you want to make sure that it's aligned with the government's vision within the sector. And in the case of a concept note, a lot of concept notes are being developed nowadays without any pre-feasibility study. But it is also advisable, if you have the time and resources, to already engage in some pre-feasibility studies. It is common to see this in projects in GCF projects that are building on existing or past projects, or they have been implemented in areas that have benefited from a lot of development projects in that same area or sector. Whenever possible, always use consultative approaches to gather information whenever possible. Even in the case of COVID, you want to also engage with people from a distance. But you want to also be able to justify or show that there was a lot of engagement with some of the beneficiaries or potential actors that will be involved in the project. And you want to also secure co-financing in writing. It's very crucial. Otherwise, all the efforts will go in vain. And securing co-financing has not been easy. It's not easy, even within the context of an accredited entity who is developing its own project. I have seen cases where accredited entities, they are not able to provide co-financing within their own institution. It's not that easy. So you want to make sure that as you're working on the technical aspects, you are already engaging on discussions related to co-financing, either within your institution or outside with the government or other partners involved in the project. Most often, they will recommend financial commitment in terms of co-financing. But I was quite, I would say, I've seen a couple of cases where co-financing has been made in kind, where the government is providing buildings and staff and so on, and then they convert that into co-financing. But I don't know how popular this is. I don't think this is something that the GCF is really recommending. Most of the time, they want to see co-financing in terms of funding. And you want to demonstrate your exit strategy very clearly and have a strong rationale for climate and why GCF should be the one funding most or part of your project and not your government or another development or technical partner. So I think these are a couple of some of those best practices that you want to engage in when developing a project proposal. So I will stop at this stage. This is nowhere close to the depth and breadth of all the issues that needs to be covered in terms of preparing a GCF fund. especially a funding proposal.
Okay, thank you very much, Professor Kalame Fobisi, for a well-detailed presentation. There are a couple of questions already which have been asked on the chat, which we are going to take later. But before then, Barrister Titi Akosa, please, we might just be able to give you about 2 minutes to just say a thing or two before we move to the question and answer session, and then try to see if we can round up this workshop within the next.
Thank you very much. Thank you very much. I think the prof has done justice to the project level presentation, and I think it's very, very interesting, some of the things that were presented there in terms of what needs to go into the concept notes and a few other practical issues that he himself has encountered. And I think that is very, very important. But there's one more thing I just wanted us to stress also. And one of them is about engagement, stakeholders engagement, especially towards the project preparation. And it's something that the GCF takes very, very important in terms of ensuring that all relevant stakeholders are consulted. Not only that they are consulted, their issues and concerns are also reflected in the project proposals, and the proposal actually tells us how those needs are going to be met. Apart from that, I'm also looking at the concept note itself. The concept note also, because there are times when you look at the different kinds of projects, depends on how you are bringing them to the GCF. For instance, if it is the SAP, which is the fast approval process that we normally call it, the concept is very, very important in terms of putting in all the most important things that have been highlighted by the professor. And we must also remember that even in your concept note, it must also reflect gender aspects that needed to go into it, because so from the outset, gender must also be mainstreamed into the concept note. And I think overall, the GCF process is something that everybody is still learning, and we keep on engaging the process and ensuring that that process also works for everybody and things like that. But there is one important thing that the prof said in terms of the appetite, in terms of accredited entities and doing large businesses. And if you look at the GCF, the smallest grant is $10 million. $10 million. And for some countries and for some accredited entities, it's something that is a bit big. And for us in Africa, and really, really looking at Africa, we really need to step up our game in terms of preparing ourselves and opening up our also NIEs at the national level, also to be able to accept, absorb large funds, so that we'll be able to get that kind of critical financing that we need to address climate change in Africa. Because whether we like it or not, the GCF and most of the climate funds are really there to ensure that developing countries who are suffering majorly from the impacts of climate change actually have that opportunity to get that finance delivered to them. And the only way we could get this finance delivered is through these accredited entities, through the national implementing entities. And it is very important for those national implementing entities and AEs also ensure that they get themselves prepared for that funds. And that is where the issue of readiness comes in. The readiness aspect of the GCF is very, very important for us, because it helps us to get the direct access. Because for us in the developing world, direct access is key. because it makes us to get more of the funding that we want, rather than going through international accredited entities where they are like intermediaries, and we know intermediation costs and so many other things go into it. But even looking at the GCF itself right now, we found out that we have a lot of these funds being assessed for us through international accredited entities. And it is very important for us as African countries, developing countries, for us to ensure that most of our countries get access to the readiness funds that prepares us so well for the bigger fund that we are looking for. So it's very important for us also as developing countries to really focus on the readiness processes of the GCF. And I think, and that's where it's very important for us, and all the gender issues. And we must also understand that at the country level too, we can engage the GCF from the standpoint of stakeholders like civil society. And finally, and I must say this about civil society plays an important role, especially at the board level, because we have representative in the board who makes intervention based on what is presented at the board level. And most of the intervention of the civil society are taken very, very seriously, because I'm part of the DCF civil society, and I've seen severally most of our intervention have even stalled some project proposal from being approved. So these are very important things that we must take note of when we're developing our GCF projects and how we engage with the GCF process. Thank you very much.
Yeah, thank you very much, Barrister Titi Acosta. Time is fast spent. While we prepare to... Hello, Surajo. Surajo, can you mute yourself, please? Surajo, mute yourself. Now, while we prepare ourselves to take the Q&A, I would like to call on I'd like to present the following questions, which I think responses are required from Professor Fobisi. One of the questions I have here is from Flora Rema. Flora Rema, it says, development projects versus GCF projects. I think I need a clear understanding. What is the difference between development project and a GCF project? Prof.
Yeah, development projects are the projects that we are used to having funded by development partners through bilateral and multilateral financing mechanisms and banks. It's the business as usual development project that you have every day. But when it comes to GCF, you must show that your project is trying to solve a climate change problem. So your entry point for your project is not development, it's more about a climate change project, either a problem which you are trying to solve. And it can be from an adaptation perspective or a mitigation perspective or both. If it is an adaptation perspective, you want to bring out maybe issues related to drought, flooding, insect infestation, heat scorch, and the devastation that the changes in the climatic system is causing to your project area or ecosystem or community. That should be your entry point. And to justify that is a climate change project and not a development project, most often you want to show projections on precipitation, rainfall, in the next 60 years from when you are, let's say 2021 up to maybe 2100. Okay. But you also want to show that in the past 30 years or more, there has been a steady decline. Rainfall is, decreasing, or even if the rainfall is not decreasing, the distribution of rainfall is changing. So we have situations where you have the same quantity of rainfall within the same year, but the distribution is changing. Instead of being spread over 4 or 5 months, it's just within 1 or 2 months. And when it comes, it's very heavy. So these are the sort of climate insight that you need to bring forward to justify that this is a climate change project. And most of the time, you want to use climate terminologies, as I have earlier said. You want to even come up with your conceptual explanation using the climate change risk framework, which is, or climate change vulnerability framework, which is a function of exposure, sensitivity, and adaptive capacity. So that is where You might develop a development project, bankable, good cash flow, but it doesn't sound climate change. And that is where a climate change expert needs to turn the project to make it read more as a climate change and rather focus the project on climate-related issues as justification to request for GCF funding. So you don't stay in the logic of poverty alleviation. No, you stay within the logic of addressing the devastation caused by drought and changes in rainfall patterns and increase in temperature over the years. And you don't say this increase in temperature with your mouth. You need to analyze climatic data over 60 years or so, comprehensive, complete, and using different IPCC models to show that there are different models. So it's a highly technical area which needs to help you justify that this is a climate change and not a development project.
Okay, thank you very much. Before we take the next.
Your microphone is muted, we don't hear you.
Sorry, before I take the next set of questions, I would like to draw delegates' attention to a link in the chat box, and there is on post-workshop questionnaire for delegates. So please click on it, and while we are trying to round up, begin to send in your comments. Thank you very much. Now, Prof, I'm back to you. There's this other question that I have here. It talks about why is livestock combined with agriculture? Livestock emits about 15% of greenhouse gas and needs a different approach, mitigation or adaptation from crop production. This is from Sirak Bata.
Prof. Thank you very much. Yeah, so if we look at one of the 4 areas under mitigation, I said there are 4 areas: energy, transport, buildings and cities, as well as agriculture, forest, and land use. So where you have agriculture, forest, and land use, or forest and land use within the context of mitigation, that is where you can situate livestock-related issues because it happens within the land use change. They are burning grasslands and is emitting greenhouse gases. The livestock are also emitting a lot of greenhouse gases. So that is where you can capture it. However, people present it differently within the development sector. Within a country, you might have a ministry in charge of livestock, different from a ministry in charge of agriculture. But within the context of GCF, you just want to follow it and address it under forest and land use related sector. And that is where it is situated. Now, in the context of adaptation, you want to also bring livestock under where you have food security. It depends how you present it. You might also want to bring livestock not under food security and water security, but under livelihoods and rural development. So you have the flexibility to present it within any of these 3. If it's mitigation, you present it under forest and land use. If it's under adaptation, you want to present livestock issues under food security, water security, as well as livelihoods and rural development. Furthermore, livestock-related projects can even go as far as having energy components, where solar energy are being used to run water systems. So it depends now on the specific activities within your project that will help you to identify which of the 8 areas of the GCF that you want to identify your project with. So there is no need to spend time thinking about this. You just need to situate your project within one of the 8 areas that GCF is funding.
Okay,
now, from a scientific perspective, IPCC, now you will still have to have it under a sector, AFOLU, agriculture, forest, and other land uses. So depending on what you are focusing on, you address it appropriately. Under GCF is under the AGCF investment areas.
So thank you very much, Prof. We still have a couple of other questions. So I would like to encourage Professor Fobisi and Barrister Titi, please go through the chat and begin to provide a response so that everybody can see for the ones who have not answered already. But meanwhile, before we take the closing remark, I would like to call on Dr. Eugene Itwa. I think he has a very short presentation, which I think will be of help to the delegates. We'll do that for about 5 to 6 minutes. Then we can take the closing remark and we'll close for the day. Dr. Eugene.
Ladies and gentlemen, it's been quite exciting for these very past 3 days. And I believe all of us must have benefited one thing or the other. Just to quickly tell you that we want to appreciate African Development Bank for this very beautiful program. We also want to thank the association for this very program as well. We are not to be for their efforts. We are not to be for their spirits. And indeed, we are not to be for their drive to support the African continent. For us to grow in a manner that everyone is happy. Of course, we wouldn't have been doing this. So we want to appreciate everyone. We want to appreciate them as well. Just to quickly tell you that in support of all of this, Natural Eco Capital has been coordinating. Just to let you know a little bit of Natural Eco Capital and how Natural Eco Capital can support you. Earlier, Stan and Adeojo had talked about partnership, collaboration, capacity building, and indeed, not too long ago, Professor Fobisi said terminologies, the climate change balance. How do we embed this in all that we're doing? That we know we can certainly support him. We have strategic partnership, like have been mentioned, with different organizations. And with that partnership, we're working with the first electronic exchange of voluntary carbon markets. Do you want to trade online? We can provide our services for you. And indeed, even the technology registry itself, that can also be developed for your country if you are interested in this. And out of that, we supported the Nigeria Rep Secretariat in designing finance framework and also a system that can assist them to create, issue, and transfer high-quality forest carbon offsets. At present, we are supporting the Nigerian government to develop the 2050 long-term vision for Nigeria towards the development of the long-term low-emission development strategy. And of course, we just supported them in the mitigation aspect of the BUR. Ladies and gentlemen, we're also working with the Global Legislators Organization for a Balanced Environment. And out of the collaboration, we have been supporting financial institutions. For instance, the sustainability champions in Nigeria, we supported them, training them. What about project developers and other financial institutions? We have also provided sustainable green financing training. Even for the regulators, we are also helping them to see how they focus on the emergent issues of sustainability. Are we looking at climate change? Are we looking at natural capital? Are we looking at circular economy? All of this, we're supporting the government on. Ladies and gentlemen, even for the aviation sector, we are also in partnership with the Nigeria Civil Aviation Authority to create awareness and indeed build capacity on how COSIA can be taken in terms of implementation. What else? We have also worked with Nigeria Stock Exchange in building the capacity of the climate change department on green bond. What about the CBN? We have also provided a number of training for CBN. And indeed, carbon, environmental, and social risk for commercial banks as well. And then environmental and safeguard training for financial intermediaries that you work with. Of course, we have also provided a whole lot of training. And here we are today, running up this 3-day program. We want to appreciate AfDB for all of this support, as well as the African Development Finance institutions. Ladies and gentlemen, here are our services outlined. Do you want to improve your identity? Do you want to continue to manage your processes in a manner that you relate them to nature? We need to bank on nature. Nature, we want to see it as a form of capital. You want to give consideration to it in relation to what the risks are and the opportunities. The approach we adopt, built on existing ESG practices and translate commitment into action by helping to generate trusted, credible, and actionable information that can be used to inform decisions. Ladies and gentlemen, we have very competent professionals, and you have seen a number of them since the beginning of this training. In fact, Natural Capital prides itself on very competent professionals. Some of them in-house, some of them we maintain that very close relationship with them. Like he said here, we maintain close professional links with other experts who are senior project managers and technical specialists in their various fields of endeavor. You've seen some demonstrated here today. It is the power of collaboration. Ladies and gentlemen, even our board, we have that gender lens. 50% female, 50% males. Ladies and gentlemen, why don't you work with us to ratchet up your resilience and sustainability? We'll be able to support you. We even have a continuing professional development. We are registered under that. And so some of our trainings can indeed build your career. Thank you very much, ladies and gentlemen.
Yeah, thank you, Dr. Eugene. Just before I call Mr. Armando Dosoma for his closing remark, I have one or two other questions here I would like Professor Fobisi to provide some answers. One of them is, say, as an accredited entity, Professor Fobisi, please listen. As an accredited entity to the GCF, do you have access to PSF? That is, assuming PSF is funded by GCF. Question is from Jeremy Dan Ukai. Prof.
Yeah, thank you very much. As an accredited entity, you have access to private sector facility if the project is private sector leaning or oriented. So that is how you, and it can also be private-public partnership related kind of project, but there must be a strong private sector involvement implication.
Okay. Okay.
So I think that is the simple criteria to get access to this facility.
Okay. There's this other question for you, Prof. Can you give examples of specific risk that the GCF bear in private sector projects, in particular case of hesitant financial partnership? Can you give examples of specific risk that the GCF bear in private sector projects, in particular case of hesitant, I mean, in particular case of hesitant financial partnership?
Yeah, but I mean, the case of risk is not particular to any category of actor. The case of risk is general. I'll give you one example. Within a project, when you're identifying risk within the project, one of the risks can be financial. One of the risks can be related to limited technical capacity on climate change, especially if it's a private sector that has little or nothing to do with, climate change issues in the past. Then a risk there is in terms of their understanding of the issues and implementation of some of these climate-related activities. And how do you counteract that risk? You want to provide some level of a process or a support mechanism that will build their capacity within the implementation of the project. So that's an example of a technical risk related to the private sector who is trying to implement a GCF project. Another one can be financial risk. A financial risk can be the history of the private sector that is not used to giving out green lines of credit. They have been funding other kinds of projects, but maybe not adaptation or mitigation projects. You want to come up with activities to counteract that risk. So it's not, they are not particular risks designed for the private sector. It's on a case-by-case basis and on a project-by-project basis. Once you identify the risk, the nature, technological, financial, technical, then you propose activities to counteract the risk. And some of the risk can also be directly climate-related risk, which the project, by the way, is focusing on addressing. So the risk can be within the context of what the project is trying to address, but also the governance and implementation for a successful project that the GCF is trying to fund.
Okay, thank you very much, Prof. We will take the closing remarks now. And to give us the closing remarks is Madu Dosuma, who is officer in charge of climate change and green growth in the African Development Bank. Madu, closing remarks.
Good morning, good afternoon, colleagues. First of all, I would like to thank you very much for your active participation in this very important workshop, and also for making time in your busy schedule to be with us the 2 or 3 days of the workshop. Let me also thank the presenters and the participants for the insightful presentations and the discussions that we have been having over those 3 days. I would like also to specifically thank Natural Eco Capital team and also the Aadfi team for the great work that they have done so far in putting together the content of this workshop. As I mentioned on Tuesday, the aim of this workshop is really to put the financial sector at the center of climate action in Africa. Over the last few days, I am aware that we listened to the experts. I have attended some of the presentations on how to use climate tools in order to identify climate risk and also to mitigate them. Another important aspect I saw is the need to identify the investment opportunities that climate action presents. Another aspect I saw in the discussion is how to mobilize concessional finance, especially climate finance, for your lending operations. Listening to this variety and rich and insightful inputs from all the participants and the speakers gives me the comfort that we are all on the same page and that we are going to work all together to achieve the objectives that we set for ourselves, which is mainstreaming climate actions into the activities of the development finance institutions. I believe that this has been a very successful workshop. I would like to add that at the African Development Bank and also at the level of the Aadfi members, we would like to continue to work closely together under the African Financial Alliance on Climate Change, AFDB, in order to scale up financial flows towards low carbon and climate resilient investment in Africa. Let me conclude, ladies and gentlemen, once on the need to really thank you again for your engagement. If you were not able to share your comments or raise your questions during the workshop, you still have the opportunity to reach out to the bank's AFDB team, Davina, Gerald, or myself, and other AfDB colleagues connected here, and share your comments and perspectives. as soon as possible. And we'll do our best to address your questions and queries in order to make sure that we are all together, as I said earlier. So thank you again for your time, and enjoy the rest of your day. Thank you very much.
Yeah, thank you very much. That was an excellent closing remarks. So we quickly take our closing pictures. I would like to encourage everybody present to put on their cameras. Please put on your camera. Put on your cameras. Put on your camera. Put on your camera, please. Put on your cameras, please. We are still waiting for Julius Roger and others. We're about to snap. Please put on your camera. Surajo Ibrahim, your camera is not on. Roger, your camera is not on.
I can see Gerard is here to put
Gerard,
on.
Barrister Titi Akusa, please.
Let's all just see you lay your face.
Okay then.
Just give enough
shots
to be taken.
Imprimantes. Então dizer. On va seulement besoin des ordinateurs, même les imprimantes.
Some people.
Yeah, fantastic. So say hi. Say hi.
You don't need to place, just allow people
Okay, Moses, if I throw the photos, I think that we can just leave the floor open for networking and to respond to some of the questions. If obviously is still there, I think we have a series of questions concerning the GCF. That's obviously is still there. So you can take this time to respond to some of the questions that are networking issues. I think the workshop is over, but the platform is still open for discussion.
Okay then, fantastic. Okay then. So we're going to take questions from the chat. And,
sorry, for it not to be rowdy, it will really be beautiful if we just show by the raise of our hands. If you want to speak, you will have the floor to speak, but then no rhetorics, just go straight to the point so that we can give as many as possible. Please, go ahead, Moses.
Thank you very much. Does anyone who wants to speak? Can I see your hands up, please? Anyone who wants to speak? Hi. Okay. It seems we have done justice to every single item for the past 3 days, and people don't seem to be in the mood for that now. So we would like to thank you finally for being part of this.
Moses, we don't know whether everyone has been able to fill the evaluation form that was sent through the chat box. Please, we still have about 190 of us here showing how supportive you have been. Please, let's just take the next few minutes to fill that evaluation form. It will help us to be better, and indeed it will also support the bank and the association in understanding where your needs could be. Further needs, in meeting your further needs. Thank you very much. Just click, you will see it there in the chat box.
So while we're doing that,
while
we're doing that,
hold on, Moses. Instead of posting further messages, why don't we just use that time to fill this form?
Sorry, I can't find the evaluation form.
That is the thing. So let's not post anything again. The more you post messages, the more it goes on. So I will personally repost it now. Please, let's leave it to be the only thing there. It's there now.
All right, got it.
Great.
Sorry, we sent a question in, but we were unable to, we ran into network problems, so we don't know if it was answered.
Okay, can
If you have any further questions, send them in. We will get the response to them.
No, simply, we just want to know if we are going to get soft copies of the presentation.
Well, you will have access to them.
You will have access, please. You will have access to them.
Thank you.
Post-event communication will take care of that.
And that is why we need you to fill this. You also, just to let you know, we have a register of everyone. Please, if you are not sure you registered your name very well, of course we have your names. Please do that. Send your names to us. We are there will be certificates of participation that you have earned. So please take note of it.
We have filled the form from here.
Okay.
Thank you.
But are you going to send the form to our individual emails in case?
It's just a link that we sent. If you just click on the link, I'm sure, or you can copy the link out now from the chat box, save it anywhere on your system. Then whenever you are ready, you can also fill it. Look at the chat box. You will see it. Please copy it out if you think you're not ready for it right now. So thank you very much once again, ladies and gentlemen. We want to thank you for being part of this. So we're quite happy with your participation and the way we've interacted. And see you next time. Bye-bye.
Bye.
Bye. Thank you.
Please, the IT, just allow this to be for now. For those that want to, that can have, allow them to be for some time.
Yeah, allow them to be what? Sorry, I don't understand.
Only for networking, Joseph is saying that I think we should leave the platform open for some few minutes or 30 minutes like that for networking. For those who want to network,
yes,
and connect with those who need information and share information. I think that is very, very important. The last day of the workshop, it has been restful. So just give some more time for those who want to be networking.
Okay.
And we have also sent Natural Eco Capital email to you or to this to the chat box. So you can also pick the email address there and then send us a word on how we can further support you in this journey.
Okay, Joseph, how many minutes do you think we can still be on the platform? How many minutes, like, when do you think we can close the platform? That we should estimate
anytime you need. I'm not closing. You can take your time.
All right, thank you.
Welcome.
La questionnaire Avec plaisir.
C'est donc 71, 381, 685. Conduct admis.
hearted, my friend.
Pardon?